Welcome to Trade Live with IG. It's so good to be back. And who else to welcome me but Ronnie Eggnog?
Thank you very much, Ange. Jesus resurrected during Easter. Now Trade Live with IG is resurrecting to bring you the news.
Can I be the Pope? That is the question. I have to say, 2 weeks away. Jokes aside, what a whirlwind and what a time. Rich was messaging and saying, wow, you chose a good time to be off, Ange, 2 weeks. I think I saw you halfway through. Ronnie Eggnog had lost, I think, half his body weight. It was that exciting, the markets.
Well, to be fair, this was just as the tariffs had been announced and then that China was retaliating. So the market was dropping like crazy. And then we were sitting there back to back, hadn't left our desk for about 8 hours. And Ange and Isar comes.
Yeah.
Hey, how's it going, guys?
Are you okay? I was like,
how do you think it's going?
Drink was what I was trying to say, but Ronnie was like that, and Mini Cooper was like that, and we thought, okay, maybe just step away.
So we had to shoo them away a little bit.
Yeah, it came from a place of caring, right? It came from a place of, can we get you guys anything?
Yeah.
And also, what the hell do we do with our portfolio? I did a rough calculation the day that I saw you midweek, and I was down 14%. So it was a crazy time. A lot of people down more, but I did entering the my holidays decide to take risk off the table.
Well, I didn't lose anything because I didn't look at my portfolio. So if you don't look, you can't lose.
Anyway, it's good
Jokes, obviously. Please manage your equity and your exposure correctly.
And your trading risk as well. Good morning to all of you. Do reach out because I have really missed all of you. Good Easter, everyone. Jesse 14, welcome. And Parky 1977 as well. Carlo, we have spoken before. Funky Gibbon and Voice of Voice, thank you for your amazing message. Rich, forward that to the crew, and always a pleasure. Any way we can help at all, just email us. You know the email. Maturin as well there saying hi, Ronnie. There you go.
My man Maturin.
Natural gas trade.
He's looking at natural gas. Please tell us more about your rationale behind why you think it's going to drop.
Jesse 14 talking about being surprised about the 2% drop in the oil price, considering the drop in the US dollar at the same time. Possible signs of further drops to come. Well, we'll talk about the oil price and gold a bit later on, just to get you across both those things. But let's have a recap of the week. Be gentle, of course, because today's my first day back in the saddle. But we have had so much on, the question is Powell as well. Whilst I was away, and trader friends, do tell me what your view is, Ronnie, about the whole Powell. Will he cling on? Can he cling on? Does Trump have the power? I mean, this is unprecedented, right? A president talking about unseating a Fed chief.
Yeah, it is.
Repeatedly.
It is unprecedented. I think he even talked about putting Donald Trump Jr. in charge there, saying he could do a better job. But I was working the late shift yesterday, one of many privileges of being the junior in the team. And a lot of clients were sort of expressing their concern about when you have the president of a country trying to interfere with the independence of the Fed, it loses its independence and objectivity, and you start to think that it's going to be used as a political tool. Now, I don't believe that's going to be the case. I do think that Powell has said from day one, from the point that Trump got elected, that they will not be influenced in their decision making, and they've shown time and time again that they are data driven. And for them to make a decision regarding rate cuts, they need to have the data to support it. And we are now going into unprecedented times in terms of the tariffs and the inflationary effect that can have. So I highly doubt that Powell will just go and cut rates because Trump says it. So it's concerning, yes, but I don't think we're going to see Powell sort of fold under the pressure.
Interesting to note that also the VIX, the volatility index, is punching that up for you around the 27 handle, above the 27 handle thereafter, of course, spiking after the first Trump tariff tantrum effect there. As we saw, it spiked all the way up to around 37. But as you said, unprecedented twice. There's no surprise out there what happened to markets if, there is even any question that rules can be changed so that, Trump can get JP out. There was that crazy meme, remember, where Jay was, I'm not leaving. Remember that meme?
With DiCaprio, yeah.
It's going to be a key one in the coming weeks, alongside a huge number of earnings insight as well. Of course, one that we talk about here a lot, Tesla. You excited about that one? Because I think this is going to be a painful report for Tesla.
I am not. I am very, very bullish on Tesla. So I actually have degenerate that I am, never learn from my mistakes. I have a bet on with a friend of mine in the Stockholm office. So there's a very nice restaurant close to the Stockholm office, and they serve sort of a T-bone steak for 2 people to share for about £250 there. And we made 2 bets. So I said I think Tesla is hitting 150 before the Tesla is hitting 150 before the end of the summer. Around midsummer, actually, 21st of June. And then his bet is that Bitcoin is hitting 200,000 before end of the year. So as of right now, it looks like we're both buying each other a T-bone steak. But I'm very, very bearish on Tesla because, one, we have the Chinese EVs that are doing extremely well. Secondly, we have the sort of displeasure of Musk's attention and the sort of risk that comes with that. And in addition to that, we've also seen significant drops in terms of cars delivered, etc. So it's not looking very bright for Tesla, and I wouldn't dare to touch it as at the moment.
Let's have a look at Tesla's share price there, just hitting it up for you.
I think they're down about 40% year to date.
Yeah, it is absolutely insane. And this as well is, due in part to the reason why Elon Musk is under heavy fire for the decrease, the sheer drop in its share price. The blue box there is the what I've drawn for you in the period when I talked about the pair trade between Tesla and BYD. BYD rose in that time. So if you took advantage of the pair trade, good on you. Currently, Tesla, they're unable to get above the golden perforated line 270 there, and we are looking at some really key things that have changed about Tesla as well. One of them being the fact that they've called very clearly for a special press conference after the earnings, which is something that doesn't normally happen, as I understand it, from analysts watching this space. Also keep an eye on what they say about the expectations for sales. Wall Street, of course, now looking at sales to fall a second straight year. So 2025 for Tesla, sales to fall a second straight year. Of course, many out there, including Andy Gavin, will say, Ange, this is all short term. He's very bullish, Tesla. He likes the whole kind of robotics. And of course, Trump has sunk millions and millions into robotics for the future. And Andy Gavin says he thinks this is going to pay off. But that is still pie in the sky.
I don't think if you're looking for robotics exposure, Tesla isn't the market leader in any sense. I would look at a company like ABB in Switzerland. They've been at the forefront of robotics and automation for several years. So I think if you're looking for robotics exposure, Tesla is not the optimal decision. to take, nor is it for self-driving, because then you have Waymo and Google who are leading the front there, and with Uber, taking the lead there. They've also had a pretty rough morning, but yeah, Tesla, in my opinion, my biggest concern here is, or not concern, my question is perhaps if all of these bad news are already priced in. So unless we see, an even worse than expected earnings result, it won't do much. Naturally, I hope that it'll do a lot in terms of downfall, because I really don't want to buy that 250-pound T-bone steak.
I thought about the T-bone steak. I'm going to draw a trend line here, and as you can see, taking special measures to not breach the top of the wicks there, because we have to respect the wicks and not cut through price action. And Monkey Man there saying, running out like the idea of the steak, and Monkey Man also coming up with his own projection. Can't see 150, but 170 is possible. Well, if you look at tip ranks, the 12-month forecast there as low as 120. So this is the key question, people. At which point are you a buyer of Tesla, or are you bearish from now on until things start to change on that front? Pop that in the chat, because I'd like to know as well. I don't have a short-term holding on Tesla, but I do have a very long-term view. I have a small holding in my pension portfolio. Right, Eric Jones as well. Monkey Man, were you at the top of the list? I checked earlier on, but maybe I checked a bit too early. I am on my coffee. How was your Easter holiday?
Yeah, it was very nice. Didn't do very much. I took the time and opportunity to relax and sort of recharge the batteries after the intense weeks that we've had.
Yeah.
But yeah, I've been itching to be back here with all of you guys.
On that note, let's get to overnight action. Right, welcome back to overnight action with myself and Ronnie. What a couple of hours it has been. Let's start off with the very first one. Cam and Dom, hit us up on that story. I think the first one that you put up on the slide, the Fire Jerome Powell market route. Let's have a look at the screen. What do you think of that? We talked about this earlier, and I think the most impressive or interesting thing about this is, even after markets have had such turmoil, Trump and gang are still willing to create even more turmoil. I mean, if this happens, then we're going to see markets really start to judder again. I mean, we've already seen the reaction on Monday, US stocks, the dollar plunging, long-term yields and long-term treasuries also climbing after Trump repeatedly attacked the Fed chairman.
Yeah, and his tenure does run out in May next year, but luckily Trump can't just pick any loyalist that he wants, and he can't just appoint Barron Trump in the position or anything like that. It has to go through a Senate vote, but it's looking more likely than not, and he's not gonna, I think it's quite fair to say that he's not gonna get renominated, but it is interesting to see what sort of replacement Trump will nominate to put forward to the Senate. I don't think that there's much room. In my opinion, I fully support Powell in his decision not to cut. It's a fully rational decision, and I mean, if there's anything that sort of shows the sort of market sentiment that these tariff policies are not inflationary, the labor markets are still very strong, then we could see a potential rate cut. But as long as the data doesn't support that, I highly doubt that we'll see a rate cut this year in the US, which is interesting because Europe is cutting.
Yeah.
Europe is cutting, and other countries are cutting, which is sort of begging the question to ask, will there be a flight of capital from the US, the exceptionalism? We've already seen a massive sell-off in the US, but the question is now, where will that capital be allocated? Will that go to Europe, or will that go to, you know, emerging markets? But it's safe to say that that sort of capital is leaving the US due to the uncertainty that comes up with the sort of tweets and everything.
His choice of words as well. I mean, that was, you know, the thing that really got me. You know, I know we've heard a lot from Trump, but the fact that he came out saying, you know, Powell's a major loser, right? One of the terms that he used. Also, Trump claiming there's currently virtually no inflation. I mean, it's quite easy to kind of check that data point, really. And also the fact that, you know, he's using all these words when he appointed him, right? So yeah. Trump appointed Powell during his first administration. So all trader friends, just some showing, I'm going to put up the Atlanta GDP now chart up for all of you, in case you're wondering, or any of you are wondering, you know, what kind of effect all this Trump turmoil is causing for the, you know, US economy. I mean, it's really, no, look at the green line there compared to the blue line. I mean, it's really, the Atlanta Fed GDP now estimate has crashed, really. And we are likely to see more of this, more pain, if we see this unprecedented, can't say the word, removal of JP. It's unbelievable what the administration has been saying and has been trying to achieve in a time when the stock market's already reeling, already on its knees, right?
Yeah, I don't think we're going to see, you know, there has to be a probable cause to remove Jerome Powell, and him being a loser is not one. But we got my favorite Frosty in the comments saying that why is not cutting rationale if a recession is looming? Absolutely, it's a fair point, and there is a need to stimulate the economy if we believe that the recession is coming. However, if we look at the previous economics of the macroeconomic landscape of the US and the world as a whole, there's been an extreme inflationary environment. Cutting rates alongside with tariffs will lead to an even further inflationary environment, completely undoing all the hard work that's been done by the cutting of the rates. So I don't see the rationale in cutting rates to undo the entire inflationary reversal, only to get up at a higher level. So yeah, if we see a massive inflationary spike, then we're just going to see another, you know, deflation of value and currency.
Frosty, loving your comment there. Even more, Eric Jones saying Powell was an awful Trump 1.0 pick. Tongue-in-cheek comment there.
Should bring up back Ben Bernanke. He had a nice beard. I like it.
Bigger beers, morning. Welcome back, team. Happy Tuesday. Exactly. Let's have a look at some of the other stories. Just to remind you, for those of you joining the show right now, the reaction there to, you know, even the mood music about further threats to remove Powell, US dollar sliding to its lowest level since 2022. Investors still running to the safe haven side of things, like gold, which hit a record price on Monday. We'll have a closer look at gold in a moment with Jack, but just showing you here because I've got it on my watch list, and I believe we just hit another record, haven't we, whilst we've been on air. Let's have a look at gold there. Adding that to workspace. As you can see, we are coming up to that yellow golden line that I've got there, the 3,512 per ounce mark. If it breaches that, if it breaks above that, it could trigger a gain to 3,561. For those of you that like using technical analysis alongside fundamentals, this is using the Elliott wave from its relative low, but it is hard to predict the completion of wave 5 as it were at the moment. But at the moment, the trend is your friend when it comes to gold. Right. So let's have a look at another story that has happened overnight. Apparently, let's hit up the screen there. Trump has hosted Walmart, the heads of Walmart, Target, and Home Depots for this tariff meeting. So, speaking to your, inflationary comments earlier, he talked to Macmillan, Brian Cornell as well. Those of you that are familiar with Target or like or dislike Target, I'm not a fan of Target, to be honest. Home Depot, I'm a fan of. Ted Decker to discuss the tariffs. Walmart, we've already talked about this with Martin Harris. Very, very well positioned, or rather better positioned to weather the trade protectionist agenda at the moment. So this is one to watch as, the earnings season continues.
I mean, yeah, it's an important company to watch, and Walmart is almost sort of used as an indicator on the labor market, as they are the U.S. biggest employer, U.S. biggest private employer, if I'm not incorrect. If not the biggest, they're massive in terms of private employment. But what's a bit worrying is that 60% of their goods are imported from China. So 60% of the products that are sold on Walmart are imported from China. And if Walmart is a place that you go to when you're trying to sort of cut back on spending, as we saw, Target dropped a lot as consumers moved towards, a more, cost-efficient way of spending with Walmart. But if Walmart, as well as Target, everyone's cost goes up, question is, where does the consumer turn to when they need to cut back on their spending? So I think it's hopefully there will be some sort of deal. Maybe there'll be some sort of deal similar to what Apple had. Make big investments and you'll get some sort of exemption. But if you start exempting Walmart, then what's the point of the tariff?
Yeah.
So yeah, it'll be interesting to see what the outcome of that meeting is, because it's a very important one.
I think Apple will definitely get some sort of exemption because...
Yeah, I mean, they've gotten the smartphones.
One of their biggest manufacturing bases, if not their biggest, is China.
Yeah.
And it's unbelievable that, the White House, in my humble opinion, isn't coming out and saying that, Apple's got the best products. We have to support Apple. We have to do whatever it takes. This is like the jewel in their crown. But instead, they haven't said anything like that at all. And I think this maybe perhaps alludes to tariff rollbacks further down the line.
Yeah.
Speaking of which, Frosty making a really good point there. Bonds are indeed driving the agenda. Just showing you, whacking up my page there, showing you the yield at the moment for the 10-year and also across the board here in Europe there. I think the real key will be bonds because Trump knows that they've got a huge debt pile and he needs to drive it down. And actually uncertainty does, a lot of people forget, it also drives a lot of fundies, a lot of money managers to then seek safety. And what is safe? Treasuries, right? Right. Bitcoin. What is the role for the current climate from Monkey Man? You want to take that one on? Bitcoin is one that has been...
Bitcoin is an interesting one. I was listening to the Wall Street Journal today, and obviously we have a very, very friendly sort of crypto administration at the moment, sort of adapting and improving the sort of adaptability of Bitcoin into the modern day financial system. And what's also interesting is that it's now being adopted by the large banks in the US. They've sort of taken a very big step back after the FTX failure, but we're seeing an adaptation of US big banks who are looking to get into more to that space, as they have an administration that's very supportive of it. But on the other hand, we're also looking at seeing, for example, companies like Coinbase and Kraken are now looking to sort of get a banking license, becoming chartered banks. And implementing that sort of things would allow them to take deposits and make loans and make the whole sort of space of Bitcoin a lot more sort of intertwined with the overall financial system, and which is positive because it leads to larger market adaptation. However, when you have large market adaptation, you also get market correlation. So that's an interesting thing to think about, as we've often seen Bitcoin as the sort of the digital gold and the hedge towards market movements. But with further market adaptation, it's becoming more and more correlated with market efforts. So in terms of Bitcoin, I'm very bullish on it long term, but we'll see how it sort of works as a hedge. That's my sort of biggest concern at the moment regarding it.
That's right. And the more correlation, the more sort of intertwined it is with the market turmoil that we have recently seen. What's interesting, though, with Bitcoin and a lot of, the crypto market is, guess how much, trader friends, guess how much reportedly Trump had in terms of donations from corporate supporters, and the hefty portion came from the crypto industry. Apparently, crypto firms gave $18 million in inauguration donations to Trump.
Yeah, and what's also interesting about that is that they've supported a lot of sort of lower levels as well, so sort of congressmen, senators who have been, who was running for the election. But what was funny, or not funny, but interesting, was that the sort of advertisement that they paid for was everything but crypto related. So they got the people elected based on other agendas and policies, and then they can implement the sort of crypto policy once in office.
Right, we're going to have to go to break, I'm hearing Cam say, but we'll get to your questions in just a moment. We will see you right after this. Hey, welcome to Opening Bell with myself and Ronnie Eggnog. Right.
Keeping that Christmas name alive.
Oh, I love it. Everyone knows you as Ronnie Eggnog now. Let's go through some of the upgrades and downgrades. Take us away, Ronnie.
Yes. So we got a few interesting ones. Fifth Third Bank Corporation been raised from target price. Oh, sorry, it's been lowered from 47 to 42. Dr. Horton been cut to 135 from 165. Cargo Jet has been dropped from 193 target price to 183, which is quite interesting considering the tariffs and the. Oh, do you want to go ahead?
Yeah, you good.
No, you go ahead. Do it. You got it already.
Hey, and we are off for this week where we've got Tesla and loads of other huge economic events, such as the UK consumer confidence later on in the week. But we also have retail sales, a bunch of huge other indicators. But let's have a look at the open first. Let's bring up my screen there for Ronnie. There we go. This is the opening picture.
Yeah, what do we have? The American indices are bouncing back after a quite rough day yesterday. They dropped between 2 to 3%. So we also see across the board it's quite positive. The volatility index, the VIX, is down, which is quite unusual these days. But in addition to that, we have the DAX, or Germany 40, up close to 2%. The FTSE is making a slight low comeback. Across the board, it's quite positive. The European equities are not doing as well as the American ones, but they also did not have as rough of a day yesterday, clawing back some of those losses realized yesterday. We see my favorite there, Sweden 30, up 1.25. It's a very interesting day to see. I think people are sort of buying back a little bit after yesterday's sell-off, but I think we're all sort of waiting and taking a bit more cautious approach to see what will be tweeted and said during the day. But yeah, now with the European markets open as well, we're now fully back to normal open hours. We're gonna sort of see a more of a normalized behavior in the markets.
Right, and that's really a robust set of numbers for the open, given this comes at a time when Trump has called for lower rates again, you know, and taken aim at Powell. Let's have a closer look at the granularity of these indices. Checking in on the FTSE first, let's have a look at the gainers. Here we go, Ronnie.
Yeah, we got Endeavour Mining, Vistry Group, Fresnillo, Sainsbury, which was cut quite interestingly, is up. They were cut with a target price to 320 from 340 by Barclays. But they're up on the day. JD Sports is up. It's a miracle. But across the board, we see the sort of the big names, the miners, the real estate developers. Unilever is up, which is quite interesting considering, I mean, they've taken quite a beating lately, but Unilever is a global company in the sort of household market. So it's going to be interesting to see how they can maneuver this new sort of tariff-heavy environment. What's sticking out for you, Ange?
Speaking of Unilever, that's one of the ones that I added to when everything got beaten down, because they have a really good defensive portfolio of things that we still need in good times and bad times, right? So their consumer products, all their soaps, and now they've branched out into men's sort of like consumer / Medicare, because the margins are better there as well.
Right.
So they're a good defensive stock to have.
Absolutely, I agree with that. They have a very wide portfolio of products. How much it'll move, I don't know, but it's definitely a strong company with a good balance sheet and a good fundamental business behind it.
Yeah.
Not that fundamental analysis matter much these days.
Yeah. It still gives you the ability to, after you've looked at the fundamentals, to give you the entry and exit points. So it's good for risk management, right? Helion, the other one too, that's a good defensive if you use Sensodyne like me. I've got sensitive gums. Okay, let's have a look at some of the losers there. On top of the losers board, Melrose, Smith and Nephew. Rolls-Royce getting a pounding, well, not so much a pounding, but down 1% there. But it has also been dragged down recently after a really good first quarter.
Yeah, they've had a very good year so far, so they should not be complaining.
Yeah.
Scottish Mortgage Investment Trust, most likely it's due to their Tesla exposure that they have there. But overall, Scottish Mortgage Investment Trust, it's a company that I and Luke Moore are very big fans of, due to the diversified exposure that they have in the different sort of fintech and tech space. They're also just taking a position in Nubank, the Brazilian Novo bank with over 100 million clients. So that's one. That's one I'll definitely pick some up in the ISA to buy the dip.
Intercontinental also down 0.5%, along with WPP and also United Utilities. Those trading Intercontinental will know that this company has been doing the real estate light hotel strategy for a long time. So they try not to own their actual real estate, but they lease it, and it has so far in the past few years been doing well for the company.
Yeah, it's a sort of strategy that's been implemented by companies such as Marriott and their brands as well. They simply sell the real estate. They allow the franchisee to buy the real estate, and then they can lease their operating system, loyalty points, loyalty system, as well as their brands. So it's an easy way to sort of get the profitability up and the operating margin. But they're also, I quite like Intercontinental because they have a diversified sort of group of hotels for different price classes.
Yes, look at you. You're like a hotel. I didn't know you knew so much about hotels.
You
look like you've got expensive taste though. You're more a Marriott kind of guy. More...
When I was in high school in Sweden, I was working at the Grand Hotel in Stockholm.
Nice.
Which is the only Scandinavian hotel that's a member of Elite Hotels of the World.
I'm going to remember that. But you're right, they've got a great diversified portfolio, and the family one is Holiday Inn.
Yeah.
But they have all these posh boutiques as well on the top end of the spectrum. They've been very good at acquiring to fill out all of the
grab the
portfolio.
entire chain.
Let's have a look at Germany. Germany 40 there. Here are the winners.
Okay, what do we have? Commerzbank, they are up, which is, I mean, they've obviously been in the space quite a lot. I think people are seeing some sort of relief after they perhaps might not be acquired by UniCredit, but they are still doing quite well despite that. Volkswagen, yeah, poor guys, they've really been struggling lately. It's good for a change to see the autos do quite well. We got Volkswagen, Porsche, Mercedes all doing quite well, up slightly. Nothing to write home about, but it's always better than to be down. RWE is a company that I'm looking quite carefully at these days, as Elliott Capital has taken a quite significant chunk in a position in them. So that's a company that I'm really excited to follow, to see, much like what we've seen them do with BP. What else do we have?
Just having a look at Porsche as well, because this was one that was really good. After the whole tariff tantrum, I don't know whether you can see, I came off it before going on holiday, but there was a real... I wrote a lot of comments here because can you see early Feb Trump hints at auto tariffs? So that was a short for me. That's a clear short. Well, if you shorted any, let's be honest, if you shorted any European car maker,
yeah, you've
been good. And then there came this. Can you see this signal? So obviously this is to do with fundamentals, but as I said, if you're using technicals, it's good because it gives you a heads up. Fundamentals tell you what to do. Technicals tell you how hard to hit it, or when to head for the exit, or to double up or increase your position. And when I saw that, I thought, you know what? This signal in itself tells me that the buyers came in, and you see that long wick over there, but they weren't strong enough to keep the open and the close. So the body, they could not keep it high enough, and therefore it sank and closed lower. And that to me was a signal that this trade was getting exhausted, right? You didn't see any more volume come in, it's getting exhausted. And there we see it, it's plateaued since then. This is the daily chart for you. Let's get back to the Germany 40 and have a look at the losers list there. There we go. Not a very long list, but Ronnie, take us through it.
Yeah, Siemens Energy and Siemens as well. I mean, Siemens Energy has had quite a good sort of period leading up to this. So I wouldn't read too much into this. I think it's more than, a take profit more than anything else. What else do we have there? Airbus Group. I'm quite disappointed in Airbus Group. I don't think they've done enough to sort of capitalize on the demise of Boeing. And as Boeing are slowly making a comeback, I am becoming less and less bullish on Airbus. What else do we have that's sticking out for us?
Daimler Truck down 2/3% as well. Actually, it's more an up day. Let's have a look at France 40 as well, whilst we can. Here are the winners for the French. Let's have a look. Running?
Yeah, so L'Oreal, household name, everyone knows it. They're doing, I think what's interesting about L'Oreal is that they're quite well positioned in order to profit from as clients consumers, as consumers start to shift their spending. I think they're a company that can do quite well in sort of still capturing that sort of health and wellness spend with their lower end of the target. Pernod Ricard, they've had a rough period, quite some time. They're doing a bit better.
They also had a Barclays, I think, raise its price target.
Yeah.
So
I think it's been oversold for quite some time, and they're also owners of Absolut Vodka, the Swedish brand.
I should have bought Pernod, but I bought Diageo because I was so impressed by the Guinness Zero.
Yeah.
The fact that I couldn't really tell unless I was really concentrating.
Yeah, I haven't indulged in that one yet.
Just the Coke Zero.
Exactly. I'm a bit of a madman like that.
Yeah.
If I go full crazy, I go for a full fat Coke.
Well, Pernod Ricard there raised the eco weight at Barclays. Their price target now €97, trader friends.
Yeah, and Kering is, close to a percentage gain. It's not really much. It's not really much to brag about for them, considering how their stock has been pounded lately. They're coming back a little bit. LVMH are already losing. They've lost their spot as the biggest luxury brand. Kering, I'm not even sure where they are on those rankings anymore. But if you look at the chart, it's quite dire how it's continuously, steadily gone down. I'm wondering if we see some sort of support at this level. What do you think, Ange?
I think the trend is still your friend, and it's still, look at it. I'm going to draw it out for you just so that you can get a better view on this. So there we are. That's just a rough, paying attention not to go through price action because you have to respect the wicks even. It's quite tricky using this. There you go. And so you can see there that we are still seeing this to me is still a clear bearish trend. And if you see the last leg down there with my cursor on the 6th of April, you can see that coincides with a huge volume spike. Can you see that there?
Yeah.
And that vertical, I'm going to draw a vertical line for you there. And please do use these wonderful devices on the IG platform because it really does simplify things and makes it easier on the eye. That to me was another big, let's head for the exit. Yeah. And until we see a break above this trend line, or if you use moving averages and you see a golden cross, for example, then this trend is likely to continue, especially with all this tariff talk at the moment that's causing an erosion of confidence.
Yeah, absolutely. And with the sort of biggest market being China for Kering, and they've taken a big hit in terms of consumer shift even prior to the whole tariff discussion. So yes, I am very, very bearish on Kering.
Let's have a quick look now at some of the broker upgrades and downgrades that have just snuck in. Tate & Lyle raising to overweight at Barclays. Price target now 740 pence. Maersk as well. Am I saying that right? Maersk. Cut to sell at Fenley. Price target now 7,800 kroner. And Novo Nordisk also cut to neutral. Sainsbury's. Do you ever watch Sainsbury's?
I shop there, but just before we move on to that, Novo Nordisk,
Yes.
they have dropped quite significantly, falled over 9.8% after Eli Lilly have produced some quite positive. I think you're on the Netflix chart here.
Yes, I'm trying to get back to my.
But anyhow, yeah. So Novo Nordisk, they dropped close to 10% after
Come
Eli
off my
Lilly
chart.
have produced some positive data in terms of the obesity pill. So obviously they've built up a very, very successful business in terms of the injectable sort of anti-eating medicine, if you want to call it that. But now, obviously, with enabling that through oral infusion is something that could, further enhance market adaptation. And Eli Lilly have produced positive results in that space, which Novo Nordisk have not as of yet. So that's something that's sort of taken against them. And if you look at the sort of Novo Nordisk chart, I think after that drop, that if you look at the sort of first significant drop there, do you see in the beginning of the year, just there, yeah. I bought the dip there. Turns out it wasn't very much of a dip. It was very much the beginning of the bottom. I was very, very bullish. I bought them even before that spike. Yeah, so I dropped them down there and they just continued to go downwards, had to eventually close out. Novo Nordisk is a company that's quite intriguing to me because I still think they have strong fundamental business and they have an outpacing of demand over supply. However, it seems like their competitors are starting to run laps against them with Eli Lilly coming up, and they have also produced now 2 studies with quite disappointing results. I think the only positive was that Pfizer didn't produce very good results, or they dropped their weight loss drug trials. So Novo Nordisk, I don't know. Can't trust the Danish.
Let's have a look at Pfizer.
I'm more bullish on Eli Lilly. I think they're doing an excellent job now. So I sort of switched that view around.
Yeah, so Eli Lilly as well has been very proactive in the outside of the skinny pen market as well, an anti-obesity drug. So we've got fast markets next. We'll talk more about that. Do stay with us because we have Matt Arbour coming online with us quite soon.
Right, blimey, what do you want to do?
Hey, this is Fast Markets with myself and Ronnie here, taking you through some of the huge moves this morning, looking like an up session, early start here in Europe, but it is still early just yet. Ronnie, what are you seeing?
Quite positive across the board. I think the biggest sort of winners are a return to FTSE, which is always positive to see. So it's quite interesting to see that the European markets are doing, even though the US is seeing a sort of a buyback, we're not seeing a sort of capital flight from Europe, but rather instead we're seeing a larger gain in Europe, which is interesting to see. And I'm going to continue to follow the European markets to see how they benefit from the volatility in the American markets.
Yeah, of course, all this coming after Trump ramped up his rhetoric, his attacks on JP. This all causing a lot of concern out there, understandably, about the central bank's independence in a time when markets are already trying to struggle to grapple with the ongoing erratic trade war that Trump has launched. Just taking you through some of the big moves. We had the dollar, for example. Let's just have a look at the dollar index there. This is the US dollar basket, and going to add that to workspace there. See the move there, as it were. And also, of course, treasuries seeing a big move as well. Gold, that's a fascinating one.
Yeah, we hit 3,500, I think, is it the first time ever? And it's very interesting to see the sort of, so Goldman came out, as we all know, I lost my bet against Rich on the $3,000 gold before end of March. But Goldman sort of came out at the beginning of the year saying that we believe that gold's going to hit 3,000, and that was a very bullish call. And now they've quickly revised that a month or two ago to saying that they think that gold's going to hit 3,500 before the year ends. And we're not even halfway through the year, and we're already at 3,500. So the question is, how long will this continue? Well, as long as there's a flight to capital, flight to quality in terms of capital, I think we're going to continue to see a rally in gold market. It's going to pick silver up with it as well. I'm just curious to see how long this can last, because obviously the volatility in the US is going to last, but sort of what's the target here? What's the price target for gold? How high can we go?
Well, as I said, a break above that 3,512, which we're very close to right now, could trigger a gain to 3,561. I'm looking for a close above that level. If you guys are wondering what Ange means by conviction above that level, just having a look as well, because what I'm interested in whenever I see gold rise and the dollar being weak, which it is right now, is that it makes me think, let's have a look to see what this is doing to miners. And so they're not trading at the moment, but I will be watching companies like Newmont Mining, for example. Barrick Gold is the other one, so Barrick Gold as well. And one of these, there we go, is an all sessions, so we will know shortly in how many more minutes, Ronnie? 8:24. We're back to 9 a.m. for all sessions, right?
Yes.
Yeah. And so these are key ones to watch. And I would really, really suggest as well that if you trade this space, you'll see on my watch list here, can you see I've got UK listed gold miners, but I also have South African gold miners, and I've got my Canadian gold miners list, because when you see a move up by the miners in places where they've started trading, right? It gives you a good heads up, like a vanguard, as to these others. When they wake up, when they start trading, they're going to see rises as well.
Lundin Mining, are you aware that they're one of the, if not the first company in history to be prosecuted for war crimes?
Oh, interesting.
In Sweden.
Wow, I did not know this. Ronnie is a wealth of information here. Copper is another one that we're watching. You like copper, Ronnie?
Not
But isn't
really.
there a saying that whenever you find copper, you find gold, and vice versa?
I'm not much of a copper digger. I have to admit, I haven't done much digging in my days. Just look at that chart. Like,
I mean,
what's
right?
even the price, Ange?
I was trying to do a Fibonacci there at that point, and there was also a rough calculation, which actually came to pass because it did rise, see in that channel. But copper at the moment is rising once again. I've written. You'll always see that I try and, because I don't like looking at a chart and then not knowing what my thesis was before.
Yeah.
So if you whack up my chart here, you'll see that I put down sort of resistance levels when we get back up to that range again. But right now, copper is, progressing slightly higher. This is the daily chart there. But there is mixed risk appetite at the moment. So be aware. And also the volume chart down there not showing me a lot of upward conviction.
And on the topic of commodities, our good friend Jugger is asking if we're looking at the lithium market. Have you had a look there?
I haven't had a look at lithium recently. Have you?
No, I have not. But I think it's interesting to have a look at the sort of lithium market and anything that's sort of EV exposed, because they've taken a significant hit in terms of pricing. But I think we're going to see, a sort of revitalization. I think everyone's sort of, we're moving back to fossil fuels, etc. But eventually we'll have to come back to electric vehicles, and that's the long-term play. So I'm interested to see what the lithium market will do. We'll see what you think will happen there.
Well, it's interesting because, the moment Trump came into power, I did kind of think we are going to see a reversal of the whole kind of lithium play, and hybrids will become, the way forward for the industry, just because we're in a period of consolidation. No one really knows how it's going to head. If you look at the car stocks like I do, you'll know that Mercedes has already started to sort of ease off, as it were, on its EV production. I was in a Porsche showroom recently just to chat with the salespeople there. And they have some EV models coming out, but really the bigger models that they have, they are more hybrid orientated. So you can see that starting already. I also know that Trump is going to look at fast tracking, if that's a term, to get permits out for 10 mining projects out there to supply copper and lithium. So jugger, and if you are taking a look at lithium here, pay attention to this, because it means more supply. More supply means downward pressure on prices.
Yeah, flood the market. We love that.
Some of the questions coming through on the chat.
What do we have here? Albemarle. You know what? I'm gonna be completely honest. I've never heard of those.
Albemarle. Albemarle.
I'm passing that one to you.
Jugger, that is quite. Do you trade Albemarle? You are the man here. I don't normally trade Albemarle as well, but I will look it up for you. Here we are. Right, Albemarle, here we go. What is obviously a big thing here for Albemarle recently is its debt to equity ratio has been in focus recently. And we are seeing, let's punch that up onto the board here. Here we are. Oh, in terms of a trend, I mean, that is jugger, clearly a downward trend. I hope you are going to say that you are shorting this. Maybe that's why it's got, the queries, issues with its debt to equity ratio. But Albemarle has that Nevada lithium mine. This is interesting because if we do see this expansion of mines for lithium, then lithium prices could be under pressure. So that to me just means further downward pressure potentially for this stock. Right, Cam's saying we have to head to break right now. Thank you so much, Ronnie.
Thank you for having me.
Have a really, really good rest of the day, and we'll catch you on the trading floor.
Thank you. Likewise. Speak soon.
Stay there. We got Matt Arbour coming up next. Hey, welcome to Live on Trade Desk with myself and Matt Arbour.
Morning, Ange. Been a while.
It's been good. I missed being back here 2 weeks away.
Well, it's me and Rich were kind of remarking that you could have missed all that time, come back, it was like nothing had happened. You missed all the action.
I missed all the
action. Until yesterday.
Until yesterday. And the action could still, may well, continue with it never stops with Trump. And, I might be back for the real show.
But
right?
it was very much that 1 week in the middle where we saw the massive move, massive rebound, and it was almost Ange could come back and say, just what was all the excitement about? The Rip Van Winkle trade.
Yeah, the Rip Van Winkle. Rich did yell at me as I was going out, going, "Good time for you to be off," and was like, "Yeah." It was mental. I did check on. I'm very fond of Ronnie, as I said to him. It came from a place of care. Issa and I walked over. I mean, on my last day, I could have legged it out, right?
Yeah.
I walked over, and what I actually wanted to say to Ronnie and Minnie Cooper, because they're right there at their desk at 10:30 that morning, was, do you need a stiff drink? Because they look absolutely ashen, absolutely ashen. And it was, I think we talked about this before I left, and it was near the time when the VIX was like punching 37.
Yeah.
So, but it's good to be back. Good to be back to see that we have seen, you have missed it, but maybe I haven't.
Well, of course, pro like you, following the market.
Yeah. Maybe I've come for the Jerome Powell push trade. Is that what they're calling it now?
It's an interesting
anti-Powell type trade.
It's an interesting one, isn't it? Going to battle on the socials with your Fed chairman.
Yeah. I mean, you look at just whacking up my chart here at the moment so that our trader friends can see. You'd be kind of like, if you just come back after a long holiday, you think, oh, actually it's not so bad. But we have seen a historic few weeks, haven't we?
Well, yeah, I suppose, and all you have to do is look at gold, and I suppose if you look at the dollar as well, that's where everything's played out. That the relentless rise of gold to 3,500 is quite incredible. That some of the moves we've seen there, and looking at euro dollar, dollar yen, some of those big dollar crosses. That's the the
Here we are.
weakness of the dollar is the story really playing out that hasn't been quite so prevalent within equity markets until yesterday, when the equity markets took another fright, a kind of a move against the Fed, the steady hand on the tiller,
Yeah.
being pushed off.
And we were just talking about this earlier. The words that have come out, from Trump about Powell as well is quite remarkable. But that aside, indices down across the board. I mean, this is after the latest anti-Powell tirade. Dow down 3%, S&P down 3.27, Nasdaq down 3.5. Let's call it. At the same time, this is coming when trade tensions are deepening, not easing.
Completely, and I suppose the big question for this week and next week is what this means for earnings season. Are people zeroing in on earnings? Obviously, Tesla this evening, Google later in the week, but are these going to play out, or are we going to look at the macro on top? Is that going to be more important for people? I think we saw Netflix had decent numbers at the end of last week, which I know was. Suppose it's a stock that doesn't really feel any impact of tariffs. As far as I'm aware, no one's trying to clamp down on streamers across borders.
Yeah, not yet.
Not yet.
Trader friends, I'd love to know, based on Matt's key points there, which do you think is going to be the main driver of this week? Is it going to be that anti-Powell tirade? Is it going to be earnings? Is it going to be Tesla, if you want to be specific, or more macro? Speaking of earnings, punching up this chart for you. S&P consensus expected earnings growth for 2025. Look at the decrease since December. Has to be said, not by much though.
Well, yeah, the kind of the bank's earnings at the start of last week were supported by trading operations again, the volatile quarter, but they didn't really have that much of an impact on the market overall. So United Health. That was the story at the end of last week with the big net change on the Dow, that 10% drop on United Health after some pretty horrific earnings numbers. But Tesla this evening is the one that people like to look at, particularly the Trump Musk links, the whole Tesla story. And Tesla has had a pretty rough time of things lately. Is there? Are the earnings going to cause that bounce in Tesla, or are those kind of Tesla $1 trillion valuations just a distant thing of the distant past?
Here's the chart. If you bought into Tesla when Trump had just been confirmed that he was going to be in the office second time round, and if you held and didn't do anything, you'd be really kicking yourself right now. Because boy, has it had a painful ride. Down some 40%, is that right? And also down almost 6% after a report by Reuters that the production launch of its stripped down Model Y was delayed. And I think they stripped it down because they wanted to get it cheaper as well. This is already on top of people across the world really angry that those that bought the Model Y and Model S last year, especially the S, they'd ordered it only to find out that Musk had slashed the prices. Remember last year it was all about numbers over margins? And now there's this backlash, we're seeing in Scandinavia and everything over Musk and what's happened. So Tesla, to me, is still looking quite bearish overall. Andy Gavin would disagree. Andy Gavin Raji, he's very bullish because he says it's ultimately the robotics.
Well, yeah, so they like to say in the self-driving technology.
Yes. Speaking of which, I was let down. You was asking me about Porsche.
Yeah.
I wasn't let down by Porsche. And also, by the way, I'd love for IG to pay me enough to afford a Porsche. I was actually in there doing market research.
Okay.
Yeah.
So just a casual Saturday morning in the Porsche
they do good
showroom.
coffees actually.
Yeah,
They do good
okay.
coffees. And also I was trying to find Wi-Fi. I was stuck in deepest, darkest Dorset.
You were somewhere with no Wi-Fi yet, a Porsche showroom.
well, then I had to drive out, so I had to do lots of trips out to like buy groceries and stuff for my in-laws. But I drove out, and I was like, oh, okay, coffee, free coffee. So I spoke to. They're actually really lovely, and at the moment they seem to be quite free because, you know, if people are worried about what's in their pocket, these salespeople have time to speak to you and make coffee. You know, they're really kind of engaging, but slightly easing off on the EV pure EV pedal. So the larger cars, the larger SUVs type range, you know, they're looking more at hybrid, right? Just to cover all bases. They will eventually have to comply with EV and pure EV to a certain percentage in the UK, because that's how legislation.
They may or they may not, depending on where legislation goes.
Exactly.
Yes.
Yeah, legislation can always change, as we know. Says the person that drives the then new diesel until the government changed. Thank you for laughing in the gallery, laughing at my pain. David Boyce the voice. Thanks. If S&P heads to 4,800 again, Tesla will follow. Yes, indeed, but you know, not without some weights behind it. I think Tesla is looking like it still has a lot of issues weighing it down. What do you like driving, or what car stocks do you look at, Matt?
What do I look at any car stock? Tesla, because everyone trades Tesla. Everyone is the one that one looks at, but it's. I don't think people look at Tesla implicitly as a car stock. People aren't really trading Volkswagen that much, but people like to trade Tesla. There's much more richness to the Tesla story than there is with a normal car stock.
Yes, especially with you know, with the tariffs and everything.
Completely. But I suppose we'll talk about popular stocks. The other one that's become interesting or not interesting is the roller coaster ride on Nvidia again from last week, where I think I was sat here with Rich. Back end of last week, the time flies, 2 weeks ago after the first sell-off, and we've talked about Nvidia down in the low 90s. You know, whether this was a number, these were the kind of numbers people were talking about for ages. Oh, I'll get back into Nvidia, or I'll double up my Nvidia in the 90s, and we saw that, and then we saw the real sharp bounce up to 110, 115, but we're back down in the 90s again at the end of last week and yesterday. So this is I suppose a really interesting one, the sort of everyone's favourite strongest stock in the sector, you know, top of, you know, the market leader in chips, and trading at levels that I suppose until a month ago people would have said, oh, you know, you're dreaming if you think you're going to pick up some Nvidia in the low 90s.
Yeah.
But it has suffered. It's been a real journey if you hold Nvidia over the past couple of weeks.
And also the key question now is, you know, at which level are investors willing to come back in again? You know, we saw the breaching. You've seen how many key support levels it's breached now. Just looking at my, you know, yellow lines there. Prior to heading off on, you know, break, you can see that I was watching that key 113 support. Now we've breached that downwards, and it's the trend is still down. Well,
yeah, this is an interesting one. So, kind of on the desk. This is a very, very popular traded stock. People kind of stopped trading. The whipsaw moves had left people a bit cautious on this one, but buyers started coming back in at the start of last week on the way back down towards 100 to now, which we hadn't really seen on the way up or even on the sharp way down. So it'll be interesting to see people's resilience, whether the buyers continue or whether there's this sort of, I think what we saw part of last week where investors were kind of a bit frightened to get back into the market, and they'd seen some real confidence overall in it. Was, you know, not trying to catch the falling knife, but to try and catch the momentum on the way back up.
I like to look for three good green bars, 3 good closes in the green. And some technicians even go as far as saying they want to see 1 green Marabuzo, right? Big chunky thing to say, right, we're all clear now, everyone, you can jump back in. But we haven't seen that, have we? I mean, if you look at this in the recent, this is a daily chart that I've put up here. You know, all we've seen, look at that, 1, 2, 3, 4, 5 red bars down. 1, 2, 3, 4, 5, another 5 here. 1, 2, 3. So we're not seeing consistent gains here, or one that's big enough to actually warrant a real change in sentiment.
I suppose it's difficult when the big gains are 25% in a single day.
Yeah, totally. Do you also think that maybe we will see, I mean, there's been talk of this, you know, in the last few weeks, that we will see this rollback of tariffs by around end of May. And the fact that, you know, some of these companies have been really hit hard. I mean, I'm really surprised that the US government haven't come out in more support of NVIDIA, because, you know, they're talking about how, oh, it's terrible, they're selling all the fastest chips to, you know, our competitors, i.e. China and all that. But actually, they are, like Apple, jewel in the crown of corporate America. And yet they haven't, which makes me very, very concerned about the stock.
Well, it's the difficulties that Trump has gotten himself into with blanket tariffs, in that there are certain industries that perhaps you can onshore back into the US. The concept, and I discussed it with Rich last week, you can't get the thousands of skilled workers in the US who are going to be able to make an iPhone for you. You certainly can't do it like that.
Yeah.
But it's just not replicable. What Foxconn have done. You can't just say, in Arkansas we're gonna build an Apple factory and we're gonna have thousands of people to make our iPhones for you. It's just not going to happen. And where do you pitch your tariffs? If you're talking about getting American jobs back, there's certain things that aren't, I'm sure Trump will say something different, but you can't bring back to America now, and it just doesn't make economic sense to do so. So where you've got to pitch tariffs appropriately, if that is your goal, rather than sort of this grand beating stick.
There are some companies that have actually stuck their head above the parapet and said that they are looking to expand their footprint in the US or set up shop in the US. However, it is important to note, trader friends, that until they break the ground, as it were, right, or they cut the ribbon, right? These are all kind of words, but just listing out some of the well-known brands out there. BMW, looking to add to its Spartanburg plant in South Carolina. Campari, I mean, who would have thought? Campari looking to expand its US production. Actually, to be fair, the US palate for drinks in America is very, every time I go there.
It's a mystery to me that anyone drinks Campari.
I know, right? But it is still stuck in the 80s or 70s.
Yeah.
It's like, oh, I'd have an old fashioned, or, it's quite nice in that way. Also, Honda apparently has said that it's going to move from Mexico to Canada and then to the US.
Well, maybe I missed a trick there, Honda, haven't they? They kind of didn't read the tariff memo.
Yeah. Didn't you know that? You should.
But cars, of course, that America have been building cars. Some might say not very good cars for a very long time. The expertise is there. These are industries which you can move to the States. It's heavy manufacturing, fine. Tech, less so. It's what are you trying to do? What are you trying to bring back onshore? And that longer game with the tariffs, I don't, whether there has been thought as to what the longer game actually involves is kind of debatable now with the rolling back and the flipping and flopping. But if it's about American jobs, there are certain sectors that it's probably never going to happen.
And there's a part of me that thinks that maybe this is why Musk is Trump's BFF, because ultimately he has the ability to kind of get the technology that is needed to kind of continue outputting what America needs, but without all these jobs that you can't create these jobs overnight. And as you rightly said, they may well not come back. All those, poor Brian at the last presentation when Trump came up with his tariff cafe board. Remember that? And Brian was there going, the auto worker. I think auto workers in the US they should know that all those jobs that 20 years ago, they're never going to come back. They're never going to come back.
Well, auto workers have been seeing it for a while, haven't we? Where the first production lines to get robots on were also production lines. Like cars lend themselves to that automated production, and yeah, auto workers have seen it time and time again.
Yeah, Tin Limousine, Ford Rouge, and here we are.
Yeah.
Speaking of which, we've got some really cool questions, really clever questions on the chat. Andrew McKilvey saying tariffs or no tariffs. Where are all these chips going over the next 2 years that the PE ratios imply? Andrew McKilvey, I'm looking at data centers for that. And if you haven't watched the latest Jensen Huang presentation, have a look at that, because his next focus, or his focus now really, but the next cash cow will be shrinking all the chips needed in data centers. He keeps talking about teraflops. So if you want to save yourself some time, and don't have 2 hours to listen to his, I do it when I'm cooking, because it's that long. Just look up flops on the search list and you'll get to the point that I'm talking about.
But I suppose the 20-year question, we're at the stage now where Moore's law can't apply, where everything's so small.
Yes.
Everything's so condensed, you can't get beyond the nanometer scale that we're at. So, the great driver of chips has been size, smaller power and size. That's apparently, I don't know, I'm not very good with very, very small things, but apparently we're as small as we can go. You can't fit any more onto a pinhead or a processor onto a pinhead. So where you're driving, it's not about size, that's down. It's about processing power, and I suppose it's why we end up with the quantum computing stocks and those discussions. Like, are you, if you're an NVIDIA, do you have to move into those realms instead?
Which brings me to my next point, which Matt has. We don't set this up. We don't. This is like live in motion.
No one can tell that.
Because if you then, after searching for flops on the Jensen Huang presentation, then look for tokens. So his view is once everything is shrunk, right? Have you watched Men in Black? Men in Black 2 has that kind of like, the universe is hidden in that chain on the cat.
Okay.
Because it's so small, it shrunk to that size. He then talks about tokens, right, that will help AI, or AI will be helped by tokens, and how everything's going to be tokenized so it becomes faster. So have a look at that, because that is part and parcel of it then moves to processing, right? How do we make all this faster? To what end, I don't know, because at some point there is saturation. But we also have Monkey Man asking, what's the rest of the semiconductor sector doing? Well, I've punched up the Van Eck Semiconductor UCITS ETF. This is a very broad ETF there. And I think if you remember, you heard me talking about how, if we're going to have this tariff issue ongoing, we don't have a rollback, it's going to be bad for chips, right? And as you can see here, this is the daily chart. Looking as far back as July, you can see that it started, we saw an exhaustion there, and then it was really range bound until we got to inauguration, around the time of the inauguration, and what happened? There we are. We have this downward channel there. Now, Van Eck has constituents like NVIDIA, we talked about already, but also ASML, Taiwan Semiconductor, Broadcom, AMD, Qualcomm, Texas Instruments, Applied Materials, Micron Technology. Yeah. So very broad base, right? And as you can tell, they are not liking this year-to-date return, negative 20%. So if you shorted this, well done, you. Do you want to take the next?
I was just laughing at the comments.
Monkey Man is referring that to you. Look, you have to read that one, Matt.
Evolution of biology and making chips. Wow, there we go. This is the stuff of sci-fi movies for a long time.
Yeah. Soon Matt and I will just be going straight to your head, as opposed to we won't need this kind of like log on to YouTube business. And Monkey Man, you won't have to make your tea. You won't have to listen to us and run off and make your tea. Just everything will be automated for you.
He wasn't talking about making tea, he was talking about making chips, and
I know, but with the chips, everything will be like in here. Speaking of which, I'm really not happy with the whole kind of you think things with chips have gone forward so much. So I checked out the Porsche intelligent display, and also Pete Ward will know this if he's listening. He already knows this. I was meant to speak to Kia, the EV9, but they let me down. They let me down for lots of reasons that I will not go into. So I ended up speaking to VW and testing out their intelligent screen. It really hasn't moved on very much. It's very disappointing.
Are you talking about the operating system or the screen itself?
Both. Like, it doesn't, try and anticipate that you're, trying to get out as well. Okay, maybe the parking is a bit better, but otherwise not great. Bigger B is saying, please bring up UNH on the charts, and it's in the all sessions.
I suppose it's interesting that when you're looking at a car, that's the first thing you're looking at. It's the screen rather than anything else.
Because let's face it, the drive is pretty meh now.
Yeah.
Right? United Health. You said this was the...
Well, yeah, United Health was the move last week. This is...
Look at that.
Probably not a stock that anyone is ever really aware of until you see these moves and you wonder why the Dow is down 500 and nothing else has seemingly moved. It's one of these, of course, the way the Dow is constructed with a price-weighted index rather than market capitalisation-weighted index. So all it takes is for the stocks that are large numbers to have a move, and you see a disproportionate impact on the index itself. But yeah, that was one of these things that doesn't really resonate with anyone trading a great deal until you see those kind of moves.
Well, let's just quickly punch up the RSI. I know we're almost out of time, but just checking in on that to see whether it's... Oh, it's not... it has touched 30, but it hasn't solidly moved below 30 yet. And on that note, thanks so much, Bigger Beers, for pointing out United Health. We have Jack on after this, so stay right there. Thank you very much, Matt.
Thank you, Ange.
We'll see you later on the floor.
Cheers.
Hey, welcome back. We are counting down to all sessions any moment now. It's 8:59 and we are joined by Jack. I said I wore him down. Did I wear you down?
Yeah, finally in the studio. It's been a long time coming.
You should have heard Matt harbor, safe harbor. And the other's going, you might as well say yes to Anne straight away, because at some point she's going to drag you in there. All sessions open right now. Let's have a look here at the winners, because it is a risk on day, trader friends. Right, Jack, take us through some of the winners.
Looks like at the top we've got Virgin Galactic,
Yeah,
AMC down there, a few others not to the same level, Pinterest, Soundhound, AI, and then Palantir down there, MicroStrategy. That's quite interesting.
yeah, Palantir up strongly there, 1.7% at the moment.
Yeah.
And Broadcom also up by around the same amount. Nike also up 1% there. Rich will be pleased about that because his swoosh is happening. Let's have a look at the losers then.
Right, okay, so we've got the Pro Shares, the QQQ there, JD, Caterpillar. It's quite not as many losers as winners, it seems. It seems a bit more of a positive open.
Yeah, and I think this is also quite a nice surprise given the Monday that we saw, right, which was quite traumatic given the latest anti-Powell tirade there. General Motors also down slightly, all sessions there. You can trade these, of course, from 9 a.m. You know, this will continue until the clocks change again in the autumn. But at the moment, you can take a position now. JD.com, just checking on that one as well, because that is all sessions. JD, I believe we had an upgrade or a downgrade this morning. Having a look at some of the upgrades and downgrades this morning as well. On the list, we have GlaxoSmithKline. We also had some others, namely Maersk, which is the firm that does the... Oh, my screen has gone... There we are. And what's the other one? We had Maersk as well, and we also had some others, which I'm currently trying to find. Oh, Roche as well. Roche actually is interesting because it's going to invest $50 billion in diagnostics and pharma in the US over 5 years. Right, so let's have a look at volatility then. What is that pointing out to us for this coming week?
Well, the last time I was on was before the chaos, basically. It's been a while. Since
I think you
then,
and I went off on break at the same time, didn't we?
I think we might have, yeah. I was around for sort of 2-week period of carnage, basically. But since then, we've definitely started to relax from the peaks. The VIX has come down quite a bit, to be honest. Got it here on my chart, but it's quite, if you have to zoom out.
I know, I think the last time we spoke, it was like punching above north of 37.
Yeah.
And then now it's
we're right back down.
Yeah.
27, late 20s. It's been hovering around this point for a while now. No erratic moves really. It seems like it's probably going to stay around here, and I was looking actually on the options just for the volatility skew on these. The upside skew, which is a sort of indicator as to how much we could move up or whether we're prone to a shock in that sense. It started to relax quite a lot, and I don't know if I necessarily agree with it, because I think even though volatility has come off, we're still a tweet, a news story away from returning to that period.
Yeah.
There's no way, just for the scope of possibilities with tariffs, there's no way that everything's priced in at this point.
Yeah. So have you got your chart up? Let's punch that up.
Yeah.
Jack's chart is coming up for you. And that's right. It's a strange time where you feel like there's not really a period where there's any respite. It could just happen.
Exactly. And I think it would be so immediate now. There would be basically no interval between Trump announcing something that could turn into policy. It's probably not even policy at that point, and it will move markets. I think we're literally seconds, minutes away from that when that news breaks.
Yeah.
So the skew relaxing, I don't know if I fully buy into that at the moment. It's a bit of a weird one.
So you sit in the no rollback by end of May camp?
I think, or maybe not. I don't know if I necessarily sit in that camp. I just think that the relaxing of that skew is probably a little bit too premature. I think no matter what camp you sit in, you can basically say we could easily flip back in a matter of seconds. One tweet away from everything going back as it was, markets coming off, and then we start to fully price in the impact of a potential horror show for tariffs, basically.
Yeah. So that ties in with, of course, gold as well. We're seeing all-time highs for gold. Just showing you here on my watch list there. We've got gold still in that sharp upward trend there, as you can see. Really, we're not seeing this trend being broken in any way at all. And as I mentioned earlier, we see that we break 3512 an ounce, 3,512 an ounce. That break above could trigger a further gain to 3,561. But it's really hard to predict the completion of the wave. So if you find it easier, trader friends, then it'd be just watching to see whether we have a retracement and it bounces back down, or whether we break out at that point. Just also having a look at the dollar, because the dollar is also aiding this US dollar. Still very, very weak at the moment. Punching that up for you, as you can see that this is the US dollar basket, and we had, of course, after the anti-Powell tirade yesterday, across the board, even if we take a look at the US dollar versus sterling, so putting cable up for you there, you can see that we have a similar picture in play. 130, what is it? 133 there. Levels last seen around September. No, where are we there? September 2024. There we are. So quite a marked level there. Watching to see whether this progresses upwards or we see a retracement there. What else are you looking at, Jack?
Well, you touched on gold there. Gold's probably the main topic for the start of this week, especially breaking through all-time highs, and it looks like, we could get a retracement like you're saying there. I think the long-term trend on gold is still definitely skewed to the upside.
Yeah.
I'm seeing a lot of people saying that 4,000 is now a minimum for this rally. I don't know how long that's going to take, and obviously as we head towards a potential recession, it could start to wobble a little bit. But
there you go, people. 4,000. You heard it here first from Jack.
And all of the options and the volatility skew is to
they're pointing.
upside.
Yeah, they're pointing to the upside, right? And so we always talk about, the trend is your friend. Don't fight the trend, and wait and see.
Yeah.
Speaking of time periods, we always talk about, you hear me talk about time periods a lot, and you always want to see that the monthly, if you're a longer term trader, coincides, the trend kind of agrees with the weekly. And so that's a more medium term view, and it does. And then you drill down to the daily, if that is where you execute your trade. Conversely, if you are a shorter term trader, you would then go, weekly, daily, hourly, for example.
Yeah.
And vice versa.
And they all seem to match up very strongly in this sense.
Let's have a quick look at corn as well. I had a quick look at which ones were looking interesting from a chart point of view. This is corn here. Don't know if any of you look at corn futures, but we are looking right now. Let's have a look at the weekly charts. That it may break support if it continues to fall. If we break support at $4.82, it could fall then to around 472 and a quarter to the 477 range. This is using a channel technique, right? So this is why I have that line there and the text, because that is reminding me of my thesis each time I look at it. And if we do fall below that support level that I'm looking at, then we know that the setup is ready to kind of press the place deal button. You've also been looking at, indices, commodities, the FX side of things as well.
Yeah.
Where's the skew?
To be honest, it's both in terms of volatility and skew. Gold has been the standout commodity for a while now. All that skews on the top side. There was a chart actually that I was looking at, just to go back to gold quickly. Just talking about where the end of that rally is going to be. If you take gold on a inflation adjusted chart and you take it over basically decades in the past, you see that where we are right now is not actually sort of in real terms near the peaks of the past. So it shows that if you think it is getting a bit too toppy, there probably is a little bit more room in there. But then for other commodities, it's interesting now comparing gold to silver. For a long time, or in most normal scenarios, silver volatility has a premium to gold. Maybe 2 to 1 is a bit of an overgeneralization, but it's generally quite a considerable amount higher than gold. Right now, we're seeing them essentially equal, which is very strange to see. It's an interesting one. The skew on both of these are fairly similar. Gold's a lot stronger to the top side. And then we also do crude. Crude's been quite interesting to watch, if you have the chart for that.
There we are. Oh, there we are.
Yeah, so crude's been quite negatively skewed in terms of the monthly options. The inverse skew on the top side, which is another indicator that we're going to be either flat or moving towards the downside, that started to get a lot weaker recently. And you can see there it's sort of that end of April or mid-April period, it came off as we were also seeing indices come off. Probably an interesting one to watch. There's a lot of talk around crude, especially with Trump. I'm not sure how much of it has really come to the forefront yet. There's still quite a bit of talk, and obviously OPEC is interesting to keep an eye on. But in terms of the volatility, it's calmed down considerably as indices calm down. They've kind of moved in sync.
Yeah, and the interesting thing about oil is also it's moving more in sync with the markets and less so with what the supply picture is doing, which is in itself quite interesting because generally if I would choose Brent and WTI, it'd be WTI that I would be looking at. But also the other thing that is key is that we saw that fall, but not by much, considering in the previous session there were all these reports about the Israeli Air Force simulating attacks, right?
Yeah.
So it is one that is really now just moving quite in tandem with markets. Interestingly, this move also came in a time when the kingpin Saudi Arabia said that crude stocks fell. Normally this would give it some support, but we didn't see that come through.
And we also had sort of going on in the Russia-Ukraine talks, Trump threatening to stick sanctions on Russian oil. It's obviously not as much as the Saudis, but you'd think that would have some sort of an impact, but it seems to be at the same time as we come off. So yeah, it's a very interesting point. And I'd be interested to see if it continues to follow that trend through any more tariff development.
I'm just looking at the chat there. Thank you very much, Bigger Beers. As you know, Jack and I were thankfully off at the opportune time over Easter when markets are going crazy. So the United Health Administration reworking payments for Medicare reimbursement in the USA. Eye on the prize saying, bring the clock back. Eye on the prize, Cam and Dom lobbying for the return of the clock. I love our viewers here. They have strong views. Clock, no clock, clock. Where's British Indian? You need to speak to British Indian. Eye on the prize. This person also wants the clock back in different time zones, might I add. Because it helps this person when they're listening from, I don't know why, but living room to shower apparently. Can you imagine my voice coming out in the shower? That'd be terrifying. Arsax, thank you very much. Welcome back. Yes, it's great to be back. I had a great break. I didn't feel like I needed it, but I think I did in the
I
end.
think, yeah, those first couple days,
Yeah.
you're still in work mode, and then you finally
Yeah.
snap out of it, I think.
Also, I caught the front end of the whole Trump tariff meltdown, and so that was still in my mind. Arthur Fox Haig asking you, what did you say was normally
Yes.
the ratio?
Yeah, that was relating to the volatility on those markets, particularly the 0DT, so daily options that we do. Generally, it's 2 to 1's not a blanket rule, but generally you see silver volatility being that much higher than gold. And right now, they're fairly equal. I think, actually, I could probably see, if you can go to my screen.
Let's go to Jack's screen, people, for silver.
I'll try and pull up the daily volatilities here. So just at the money, we can see we're about 39% here. And I imagine it shouldn't have changed too much. We're just under 39% at the money on silver. So those two, generally you'd see silver a lot higher than gold. I think it's probably, generally it's because gold has had this sort of wild rally and it's dragged the volatility up with it. So yeah, it's just an interesting one to see. You'd expect that to recalibrate at some point, but it doesn't look like it's going to happen during this week. The weekly markets are pretty similar. So 35 for gold and 34 for silver. So you can see that those volatilities have merged to the same level.
Yeah. Which is going to come as a disappointment to many silver traders, because I know they like silver because of the volatility, right?
Yeah.
And so if it's merging with gold, then you don't have that edge.
Yeah, exactly. And gold seems to be dragging all of the stories at the moment. I know for us, particularly seeing the client business, gold is considerably more popular in the options space.
The one game in town.
Yeah.
Right. Looking at that, speaking of the one game in town, just checking in on the US 500 and looking out to the weekly. This is still, I mean, in a week, like when we are not at jobs or anything. I mean, we are sort of in earnings season, but it is still around the 35 mark. Is that where you would expect it, or is it still slightly elevated?
No, it's definitely come down since the sort of tariff weeks, should we call them. But it still remains higher than you'd normally expect. We're probably sitting at this point, I don't think you're going to see too much movement. Yesterday it sort of fluctuated, but it was always around the 35 mark. I think it'd take something a bit more of a macro event, more announcements this week. This week's quite bare in terms of macro news. We've got a few Fed speakers. I know Lagarde speaks today, but there's not a lot driving that futures volatility.
Yeah.
So I'd expect that to stay there. I think we're going to be looking a little bit further out to see any sharp moves here.
Yeah.
Yeah.
If you're looking for trader friends of the rush to safety that is not goal, then have a look at potentially, cable, because currently the surveys that are current and just done quite recently showing that many analysts out there thinking that potentially we could be looking at around 110 versus the euro. Let's try and punch it up for you here. Here we are. And also taking a look at Novo Nordisk as well. So Novo Nordisk is, of course, behind some of the skinny pills. I think it's Ozempic. If I'm right in saying, do let me know if I'm wrong. It's really difficult to remember everything, but I think it is Ozempic. Novo Nordisk share price there, as you can see, in the red. This is all sessions, but it's currently coming up right now, but it is after several down days there. And what we often say is, you can see I've got this Bollinger Band there. Do you use Bollingers ever?
I do sometimes. I'm not a massive indicator person, just because, especially when I'm using it at work, it's just easier to see a clear price.
Yes.
But I think Bollingers and moving averages are the ones that I go to. If I'm
Yeah,
trying
it's
to
like
look
a
for
nice
little bit more
filter,
text.
right? It's like a
Yeah.
nice filter.
I think
something
so.
to read the room.
Yeah,
Right.
and you see some charts, the Bollinger Bands just work perfectly on
Yeah.
other ones.
Whoa, not so much.
Yeah.
Yeah. They're not great when it's like a blowout, right? But the rule of thumb is that when there is a narrowing, then you then see potentially, oh, this is where you need to pay attention.
Yeah.
And so we did see that narrowing around February. And then also, whenever you get to the bottom, if you close below, that's what we look out for, a close below, because that means, like here where my cursor is, that means we're about to see a reversal. Right? So if it touches sometimes like that, but doesn't close below, you can kind of like, nah, disregard it. But if it closes and it closes below, that's kind of like, okay, pay attention, because the mood music could be about to change. So take a look at that, because Novo Nordisk had a slight blip after positive trial results of Lilly's weight loss pill. Also looking at, we talked about chips earlier, I think with Arthur Fox Haig as well, talking about this, and I did show the ETF, the Van Eck one, with lots of semiconductor makers in pain, but look at those, also exposed to data centers after Wells Fargo analysts said that Amazon had paused some of its data center leasing talks for its AWS cloud division, especially overseas. All right, we have to end it there, Jack. Much as I hate to say this, so good to see you.
Too.
Yeah, we will catch you again soon. Any questions to Jack, post them to me and I get it there to him, or post it here. Don't forget to smash the like button. And Cam, who we got up next? Aaron is waiting in the wings, so stay right there.
Cheers.
Hey, welcome to the show with myself and Aaron.
Hello.
Happy Easter. Or
Easter.
How was your Easter?
Very nice, relaxing, good fun. How was yours?
I was crazy. I was driving through country lanes. I love the countryside, but the driving through hedges and things, well, not through, but, almost, is a bit full on. But,
Yes, being a Londoner born and bred, I'm not too familiar with that kind of thing. So I just get traffic jams and weaving in and out of cars and having to pull in on the narrow roads. But I'm not familiar with driving into bushes.
Well, I owe you lunch, and Chris as well, because thanks to both of you, it meant I didn't have to jump on a train to come back. Because
Well, that was good fun.
I was poised.
I enjoy working with Chris. It's good fun. We bounce off each other.
Yeah. Speaking of bouncing off each other, I'm going to put up my bonds chart. I mean, it really, given what we've seen the last few weeks, bonds back.
Well, I don't know about that.
I think maybe in the next few months, or we.
Well, if you're looking at it from sort of an all-in yield perspective, yes, I would say
Yields.
so. But I mean, the volatility we've had is pretty bizarre, but warranted, I would say, in the bond market. I mean, we had yields. I mean, 10 years, 4.4 at the moment, 4.4% yield. We touched below 3.9% at one point when there was huge market volatility, because what we do tend to see with equities and fixed income securities is that negative correlation. On the whole, obviously in certain scenarios it doesn't play out as it hasn't at the moment, but it played out quite nicely when the volatility started. It then reversed, and we've now got yields rising, which means the price of the bonds is going down, as well as equities selling off, which we've seen. Well, I mean, we saw a little bit of a rally, but obviously yesterday, US market was open, even though it's Easter. We saw about 2.5–3%. S&P 500 was down. So we're seeing a positive correlation between basically they're both selling off at the same time, which isn't good for multi-asset portfolios, I would say.
Just zooming in on that for you, the thing right now is that we are seeing the impact of also Trump calling for lower interest rates, right?
Well, yeah, he called Jerome Powell a loser yesterday.
Yes, yeah. Oh gosh, we talked about that with Ronnie earlier this morning. I mean, the language is interesting in itself.
Yes, Chris and I actually did correctly predict that in the morning slot. We were saying, what do you think Trump's going to say today? And I said, I expect quite a fruity tweet with some exclamation marks. And we both predicted that he would sort of lay into Powell, given his speech the night before, saying, don't expect rate cuts.
So what do we expect this week? Because, the data covered is pretty bare. We do have a few economic data points of note, but mostly from Europe. We've got, people coming back from the long Easter weekend in Europe. Is there a case for gilts maybe to catch up here?
Well, to an extent, but I think the UK has got its own economic issues. That's why you're seeing gilt yields, have been rising quite significantly over the past few months. There's concerns over really the sustainability of the economic growth in the UK and the policies put forward by the Chancellor, Rachel Reeves, who hasn't got the best reputation in the City of London, with many sort of people in the industry and financiers in general. There's concerns about the growth of the UK economy. So that's, if there's concerns about that and concerns just poor sentiment in the UK, we could continue to get a sell-off in the UK assets.
What's interesting as well is that, in a time when the UK has already seen a huge amount of economic pain, we're still seeing that, we're not seeing much growth come in through the policies. I know everyone says, it takes time.
The bonds aren't acting as the safe haven, yeah.
No, they're not acting as a safe haven at all. You would have thought so. I mean, barring the fact that money has been pouring into the DAX and the FTSE, I would say that's more of a away from US trade as opposed to strength in the UK trade.
Yeah, absolutely. It's like Chris and I were saying on Thursday, we saw a strong dollar euro, but we put that down to a weakening dollar rather than potentially a strong euro, which is kind of what you're saying with regards to the FTSE and the DAX. It's not that people are extremely bullish about those two. It's the best of the bad bunch for the time being.
Yeah, the lesser of the two evils.
Yeah.
So, I guess the thing here as well is, for those of our clients looking and already in the DAX, do they double up? Do they increase their holdings? Given we could have, like Jack rightly said yesterday, we could have any minute, just with a tweet, we could have another market tantrum.
Well, I mean, in terms of the equity sleeve of client portfolios, we always tend to be quite diversified, even though we do have a bit of an overweight towards the US relative to the sort of UK fund managers, I'd say. Relative to the MSCI World, we're actually a little bit underweight. But look, it's really important to stay diversified, and particularly in times like this, you know, the past couple of years you were rewarded for a lack of diversification, ironically,
Yes.
even though portfolio managers preach diversification. It's, you know,
Yeah, and those that did diversify kind of kicked themselves.
yeah, I mean, absolutely, we diversified, and most portfolio managers, you know, it's part of our risk management, you know, process to diversify. You can't sort of wing it and just buy securities you think are going to go up and you know, not consider the potential downside. But now it really does show that this is when it would have been really good to be diversified, given the relative performance of various indices. And if you were really overweight US, you would have underperformed your peers quite significantly. And I don't think your clients would have been too impressed if in that situation.
So just a roundup here, you know, dollar hitting 3-year lows. We also saw, of course, we talked about the bond markets just now, the jousting between the Fed and the White House not helping, and also, of course, Trump still calling for that cut in interest rates.
And I think investors are just demanding, you know, higher term premium, because there's just concerns over the US growth, the US sustainability of their long-term debt, and just the concerns about, I would say, inflation from the tariffs, you know, that they could be inflationary to US consumers.
Is now a time to, I'm going to be devil's advocate here, right? You know, we talk about trading and we talk about, you know, making sure you're nimble, small position sizes, make sure you're risk management, trading, all that good stuff here. But are we now in a position where, you know, if you are looking to scoop up some NVIDIA, it's really a buy and hold?
I mean,
rather than buy and trade.
Yeah, I mean, look, relative to where we were, the valuations for some of these tech companies obviously are at much more attractive levels. But look, it has to, you know, align with one's time horizon and one's own analysis if you know, they're going to be buying those securities. But look, am I happier buying the S&P 500 at 5,200 rather than 6,200? Absolutely, of course. You know, we want to be paying the lowest possible price and getting the highest possible return. I mean, it sounds like common sense, and it is. But obviously, you're gonna, you know, it's like going into a shop and buying something on discount. That's how we're looking at things. But given the macro noise, I think there's concerns that there could be more to fall. And as you said when you were discussing with Jack, the volatility can ramp up at any period. So that's why we're taking things extremely cautiously. It's not an environment like COVID where you saw this immense 20-30% drawdown in equities, but the environment was good in the sense that there was this glut of liquidity in the financial system in the form of QE and, you know, various other positive sort of monetary policy, expansionary monetary policy, which was really bullish for equities.
Are we back in potentially, are we heading towards, you know, QE territory?
Well, it's interesting you say that, because Powell actually said that there needs to be sort of a lower strike for this. So I think there needs to be a bit more of a fall in equities to get this.
And I think he was right in saying it's going to be data dependent, right?
Yeah, absolutely. I don't think we should be relying on you know, Fed put and Fed cash anytime soon. But is it a possibility? Yes, potentially, particularly if Trump ramps up pressure and we see more volatility in equity markets, and we see, I think most importantly, tariffs come to fruition. We see the end of the reprieve. We see all sorts of different items tariffs, and we see higher prices and you know, just stress in the financial markets. But there is the caveat that if you get higher inflation with the tariffs, what can the Fed do in terms of interest rates? It's this sort of dual mandate again, right?
Yeah, totally. And there's also this really big elephant in the room that if the US economy hurts, whether it's self-inflicted or not, right? Everyone else is going to feel the pain, right? Whether it's self-inflicted or not, everyone else is going to catch this cold. And we've already seen, you know, money pouring out, right?
There's one small caveat to that, which I read on the weekend, that it could actually be deflationary for Europe. These tariffs, because China is going to look for new trading partners. So there could be a glut of cheap goods for Europe, but that's a very much an if situation.
Exactly. And we spoke to Crane Shares Xiaolin as well, and she was already saying that China has, in the last 2 decades, already started the process of trying to diversify away from the US. So Africa, Europe, right? The Belt and Road strategy.
Definitely.
So just punching up this chart here to illustrate what we're talking about as well. You know, we've already seen that, you know, money coming out of US assets have had to go somewhere, right? And in the beginning, we saw European defense being one beneficiary. And then taking a look at this chart from LSEG Lipper data, investors also bought a net $11 billion in European equity funds and 3.6 billion in Asian equity funds in the week to April 16th. This coincided with $10.6 billion coming out of US equity funds. So, it's quite a marked looking
Really
at
volatile flows.
Yeah. So is this the beginning of something much bigger, or is this just a recalibration?
I think it just shows the nimbleness of long-term investors and traders during this sort of period. There's a real slew of policy uncertainty, and given that sort of concern, and given the concerns over this policy uncertainty, and given how much it can shift equity markets, you've got fund flows changing constantly, where they're trying to almost read between the lines and see what's going on. And obviously we are seeing a little bit of panic in the markets as well during these various instances where we get these sell-offs, and then we get this euphoria when the tariff reprieve comes. So an immense amount of volatility, and you do get these interesting charts during the volatile times where you see constantly changing flows of cash.
Yeah, totally. I'm just checking in on the chat now. Do you want to take us through some of the questions there? I'm loving how Monkey Man's chimed in. Monkey Man, see your message about how you want the clock back. Cam, are you recording the number of people that want the clock, don't want the clock? There are too many of you.
I own a triple leverage bear ETF. I hope the US stock market goes down to zero.
Yeah.
I can't say that many hold that ambition, but yes, that would certainly be beneficial for your position, I'm sure.
Yeah, Boston Frank also chiming in saying Freddie King Going Down YouTube is a good song for the US stock market. Use the album version, 3 minutes, 25 seconds. I'm always impressed by the breadth of musical knowledge by our viewers here. The number of song recommendations to go with stock market movements. Powell, Boston Frank saying Powell said Fed would not interfere if there was a major decline in the US stock market. He would say that, wouldn't he? Yeah.
He sort of implied that he'd come to the rescue, but he's been very hands-off. The words he used was there needs to be a lower strike, which I think he was referring to as the sort of strike price of the S&P 500. Need to be at I can't speculate with index levels here, but it would have to be a lot lower than 4,800, 50, 5,000, the sort of figures that we're at the moment, kind of thing.
Boston Frank, are you from Boston? Because it's a financial powerhouse in the US.
I've not been.
Please tell us. Yeah, I've been told that it's got really good restaurants because of all the financial companies there. Monkey Man, Google Cortical Labs for next generation computer chips. I have not familiar with that. I will look this up because that's a space that I'm interested in. Boise, are US stocks more attractive when the dollar is weak? Potential to profit from the Forex market if USD strengthens as well as the stock price rises?
I mean, we don't tend to look at FX fundamentally when valuing US indices. I'm not sure if it's something that you've ever looked at.
It's something you keep an eye on if you are trading a volatile stock that is, doesn't, that has most of its revenues not in dollars, for example.
You look at that with the FTSE when you see a rise in sterling and that kind of thing. But I mean, we hedge some of our US equity exposure to basically offset the dollar risk, the currency risk there. So yeah.
And Maturin
Hedging's been useful at the minute.
coming in to say, yes, please, we want the clock.
I agree.
He agrees with you, Maturin. I will put in a good word for you. And also, just we've got not too long to go because I can hear Axel's dulcet tones in the background. It's also a week that we have quite a few earnings of note. Verizon, I not mention Tesla as well, GE Aerospace, Lockheed Martin, Halliburton.
Big names there. And look, I think with earnings, obviously, you get this sort of flavour of momentum, which is particularly useful in terms of where the company's going, and the forward guidance, which I think is going to be so crucial at the minute. What's interesting with earnings is naturally they are lagging. They're always going to be looking back, and they're not looking at the current cash flows and things. They're obviously going to give their verdict on how they see things going. But I think when we get into earnings, sort of Q2, Q3, Q4, and if the tariffs come in, that's going to be when it's going to get super juicy in terms of how it's affecting us. How are these potential tariffs, if they come in? Obviously, there's a lot of ifs to come here. But really going to be really interesting to see what they're saying. And obviously, we saw United a couple of weeks ago release their earnings, and they're giving sort of multiple guidances in terms of, if this scenario happens, we expect this. If this scenario happens, we expect this. So, I look forward to seeing what the CEOs and CFOs are saying.
That's really interesting. My phone must be listening to you, because I've just had a call in from one of the top earnings analysts that I speak to. So he must have known that you were talking about this. I'm sure our phones are listening to us, because
Definitely.
I saw an alpaca the other day, and then when I logged in this morning, there's an alpaca on my screen.
Really?
Yeah, it's quite scary.
It's whatever. I mean, my adverts on these websites are so targeted. I mean, it's just Charles Truett shirts and gilets. And what else was it recently? It was kickboxing gear for a while. Just boxing gloves advertised to me everywhere for ages.
Wow.
So it knows what I like.
It does. And my laptop's going to show me pictures of Boston now. Boston Frank saying, yes, Boston.
You're going to get Skyscanner business class flight tickets are going to come up.
Right now, yeah. It's the second largest money management center in the US. Speaking of money management, we've got Axel coming up, but if you're looking for something interesting, take a look at Coffee Arabica there, because currently we are looking at the 365 handle, but it could fall into the 351 to 359 range after its failure to break through a trend line. So have a look at Coffee Arabica. Stay right where you are, because Axel is coming up next with his trade of the week. Not going to steal his thunder, so you have to stay to find out what it is. Thanks so much, Aaron.
Pleasure. Take care.
See you soon.
Hello and welcome to this week's Trade of the Week on Tuesday, the 22nd of April 2025. Let's get straight into it and let's have a look at today's Trade of the Week, which is to go long the DAX 40 contract. The index, as you can see here, is rising. Earlier this morning we had a perfect entry, but the DAX has already risen by about 180 points since then, but it's still a buy signal for me. So, how do you play this? Well, basically, the reasoning is US markets came off yesterday as President Trump basically once again said they wasn't very happy with the Fed not lowering rates and wants to replace the Fed Chair Jerome Powell. And on that news, sentiment soured and US stocks sold off quite sharply. And you can see here that we did the same on the DAX yesterday, but today we're heading back up again. So I believe that we're now starting to break through this downtrend line. And you can see here, if I just draw it on, that we are currently going through a resistance line here. Let me just get this right. And I believe that we will break through it. So for that reason, I would like to go long the DAX 40. So it's a purely technical trade because we know where our stop loss is. Our stop loss is below yesterday's low. So it's just below here. And our potential upside target is probably where we made the high on the 9th of April, or probably slightly higher than that. It's around 21,500. So today's trade of the week is to go long the DAX 40 index at around current levels, which are, let's say, 21,150, with a stop loss below Monday's low at, what is Monday's low? Let me just have a look. 20,669, and an upside target around 21,500 or above. Hello and welcome to Technically Speaking. Now in trading trade of the week, I didn't have time to go through last week's trade, which was to go long palladium. So that one worked out quite well, because if you look at the palladium price, you can see here on the June futures contract, we went long around these levels. We then went up very close, came very close to our upside target. So if you haven't gotten out of that one yet, maybe keep your long position, but have a take profit stop above Monday's low. So that is a possible trade you could do. But enough about me. Let's go back to you. And I've got questions now up here. And Andrew's asking me, has JD Sports finished its uptrend? If I remember, Andrew, we've talked about this also quite a while. Sorry, the gallery is speaking to me. I couldn't hear you. Yeah, the downtrend. Didn't I say the downtrend? Has it ended its downtrend? Did I say uptrend? Oh, sorry, got confused there. It's downtrend. In my mind, it was so clear. And we've discussed this, I think, several weeks ago. And I said to you, yes, it's gone down, but it can go lower. So let's see whether it has gone lower. And let's have a look. No, it bounced. Okay. Well, let's answer this question together. Has the downtrend ended? Well, for what we need to look out for in order to answer this question is, first of all, to draw a trend line on this trend. We can see we had a series of lower highs and lower lows, which is the definition of a downtrend. So if we now put our trend on, what we do is we take the highest point possible, and then we draw it through the next lower high, which is this one here, without any data going through it in the future. So that would be our resistance line, because it's got two touching points. And you can see here that resistance line actually on the 20th of March got breached very briefly. So what you need to do in order to draw your trend line correctly is to redraw it, make it flatter, and make sure that you don't have any data going through it. So in this case, we have it from that high through the 20th of March high. And what's happened now is that last week on Thursday, we broke above that trend line. We've been trading above it ever since. So that is the first indication that this downtrend may have been breached. But and this is an important but. What I personally also look out for is where the last relative high is above to the left of the trend line break. Why? Because a trend line can be broken quite often and it just becomes flatter, as we saw on the 20th of March. And you can see from the 20th of March onwards, you could have thought, well, that was the end of the downtrend, but actually we declined from 80 all the way down to 60. So that's quite a significant drop in the JD Sports share price. So where's our last relative high compared to our break? So we go to the left, to the left, to the left. This is the last relative high. Why is this one the last relative high? Because if you look at it, this is the last high on the daily candlestick chart, which is higher than the one to its left and to the right, above this trend line break. So if we have a close, a daily chart close, at least one, above the 20th of March high, which is on the daily financial bet at 81.77, then I would consider it possible for us to have broken that downtrend, but only then. So it's not just the trend line break which is important, but also the break above the previous relative high on a daily chart closing basis, ideally on a weekly chart closing basis, and then you would expect that to be a reversal and for the trend to resume. So we are not there yet, because at the moment what we need to do is just say, okay, that trend line is no longer valid because we've broken through it. If it is still a valid trend line, well, how do we redraw our trend line? Well, basically what we do, we just take that high through this one here, and now it's our downtrend with the high here from the 10th of April, and maybe we're trying to break through it this week, but right now we're still below it. So basically, watch that trend line, watch the high from the 20th of March. If we break above that and close above the Andrew, then for me, technically speaking at least, there is a possibility of that downtrend no longer being valid and us either heading into a sideways trend or into an uptrend. Right, any more questions? Clean Harbors, never heard of that stock. So let me just have a look. CLH, Clean Harbors Incorporated, here we go. And let's have a look at what happened here. Let's do our trend analysis again, like we just did on the JD Sports share price. So what we can see here is clearly a downtrend. We have a series of lower highs, lower lows. If we now draw in our trend line, we do the same thing again from the highest point. That's our highest point, drawing it through the next lower higher points, which gives us this trend line here. Now, do you think that trend line is very useful? Probably not, because we're a long way away from it. It's very flat. So in that case, we can't take the highest point. So let's try the next lower high point and see whether we could draw a trend line from this one here. So let's do that from there to this one. That's the resistance line because we've only got two touching points. But again, it's quite a long way away, maybe not that useful. So we can take this point here and just draw a trend line from this one. So let's just do that. And let's see whether this one is actually a more useful one. So here we've drawn it through that high here, and that gave me this intersection point there last week, and we tried to break through it on the first day, on Monday the 14th, didn't manage to do so, closed back below it, then closed above the downtrend line 1, 2, 3 days in a row, and now today 4 days in a row. So again, what have we seen? We've seen a trend line break. So that means we could actually be heading back up again towards these previous lows, going back to October of last year and also December of last year, or perhaps back to this longer term resistance line. But what we need to also see, as I just said before on the JD Sports share price, we need to close above a previous high. Now you can see here what has happened so far is that we did break the trend line but didn't close above that 2nd of April high. But then on the 15th of April, last Tuesday, we basically closed very slightly above that high. And then we did so again on Thursday of last week. So that would indicate to me we've now had two consecutive, well, not consecutive, but in the same week, two closes above the trend line, above that previous high. It may well indicate that we've got a bullish reversal here. a false breakout to the downside, because that low here was below that low. And if you look at it, actually, we had an early warning sign of the trend reversing its trend, because if you look at the relative strength index, can you see this low here, which fits into that low here from the 8th of April, that low was above the previous low. So on the 10th of March or 11th of March, we made a low on the price chart and then a lower low in April. But if you look at the relative strength index, we made a higher low. This is called positive divergence. That plus on the 9th of April, this bullish engulfing pattern, so where you have the green candle, the bullish candle, completely engulfing the previous day's red candle, that is also a bullish reversal signal. And then, in case you weren't sure then, you also had what is called a harami here, and basically you had an indecision, and on that day you had a buy signal. Again, so you had lots of buy signals, trend reversal, now we've got the trend line break, and you've got the break above the high. So the odds are pretty high that the lows are in, at least in the medium term. So where's our stop? That's the problem with this sort of analysis. Our stop, technically speaking, is the low going back to April. So that's down here at the 8th of April low. So it's quite a long way away, because it's quite possible that we break through the trend line, and what sometimes happens is we retest the broken trend line, it then acts as support, and then we have another attempt to the upside. So let's see what happens. But for me, this chart here, Clean Harbor, is actually looking more positive. It is looking as if we're changing direction, and it could well mean here that we are in the process of changing our trend. Now, another question here, Rolls-Royce. Let's have a look at the Rolls-Royce share price. A very good favorite. Is it a bullish bias or not? Well, basically, as you can see here, the Rolls-Royce share price, I mean, it nearly did as well as Nvidia. And lots of people don't realize that. Rolls-Royce did extremely well. This is the defense contractor Rolls-Royce, not the car maker. But anyway, you can see here that what we've seen is potentially what is called an ABC correction, a very sharp descent. And I think I showed this chart a couple of weeks ago. And you can see here, where did we find support? We bounced off the 200-day simple moving average. Perfect technical analysis here. So that was our support, bounced off it, and then we had this rally higher, but we came off again. Right now, it's like any other chart, well, most of the charts we're looking at, it very much depends on what Donald Trump says. And here what we can see is that we are still currently in a sideways trading pattern. But from a longer term perspective, if I go, for example, onto the weekly chart, let's just do that here. You can see that we remain in a very clearly defined uptrend, and we will remain so as long as we stay above the current April low. So it's quite possible the Rolls-Royce share price will head back up towards the 800 pence area. It might grind higher. Short term, we've come off with the US markets, but technically speaking, from a short term perspective, we haven't got a buy signal yet here, because we would have to rise above last week's highs in order to get that. But if you're long, if you have a tight stop, you could place it at Friday's low, the 11th of April low, or the more sensible one for a long-term investor is to place it below the 7th of April low. Now, obviously, that's quite a long distance away, but as long as that low holds, the long-term uptrend is still very much intact. But we may now be in a sideways trading phase and may stay in there for quite a while. So that is also quite possible. Right. Any more questions? I can't see any. So thank you very much for joining me on Technically Speaking, and I hope to see you again next week. Goodbye.
America's still on sale. It's Monday, April 21st, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan as we wrap up this trading hour. Futures market closes at 5 Eastern. If you're on the website, on the platform, welcome. Come over to tastylive.com, see what we're all about. Otherwise, join us in the YouTube chat. Tell us what you're trading, what you think of this market action today. A uniquely bad day for this market. Sorrow that Callie Boster at Ritholtz Wealth Management noted that this is only the second day since September 2022 where every single S&P 500 sector is down by 2% or more. Relentless selling over the course of the session that basically begins as soon as the cash equity market opens. We can turn to the charts right away. As soon as that 9:30 a.m. Eastern bell rings in New York, the selling begins, and it basically continues up until about 3 Eastern, the final hour before things stabilize. Ultimately, it's a day where the S&P 500 loses 2.55%, the Nasdaq's off by 2.6, Dow Jones off 2.65, and the Russell a little bit better at 2.23% lower. Of course, the day is largely defined by that sell America mindset. Bonds are still trading heavy and to the downside, particularly the longer end of the curve. You see that gold surges over 3% to a new all-time high. Silver catching a bid likewise. And the relentless selling of the U.S. dollar continues. Energy sector not liking that for the most part. Dylan, what's the view from abroad here as we entered the European short holiday week?
I think it's sort of more sadness than anything else. I think it's more, sadness and disbelief, I guess I would say. People understand the logic that Trump perceives that his voters are not the financial class, and they're not the executive class, and they're not the Wall Street class. They are the disenfranchised American, non-investor who lost manufacturing jobs. And I think it's like a game of, the question is, can Donald Trump basically alienate the financial class, the investor class, and the stock market class, alienate the world, and in the process reinvigorate American domestic manufacturing and middle-class jobs? It seems like a long shot. And certainly from the perspective, and I think that's why it's viewed from an overseas perspective with disbelief. I think it's not even disbelief so much about Trump at this point. It's disbelief that the Republican Party and the people around Trump are indulging this destruction.
Ilya, we make our way into a second half of the day where we get a bounce off the levels that we were talking about around Futures Power Hour, roughly 51.40 or so, as we made our way through that session. Is anything more than a dead cat bounce on a thin volume holiday Monday?
I think that's what I was asking myself as I was looking here toward the close here and thinking, okay, maybe we get a little bit more of a bounce as liquidity comes back in. Ultimately, volatility still looked very expensive, and it was very difficult to find shorts that made sense from a kind of basic risk reward perspective, even sizing up verticals. And so I wonder what happens now. I think the lack of liquidity was a big contributor today, as we've talked about before. Obviously, Europe was closed for Easter Monday, so was Australia, so was Hong Kong. China and Japan were open as far as sort of the larger-ish markets. Japan, obviously, much larger than China. But other than that, things were pretty thin. So I wonder if we don't get a little bit of unclenching still and get an opportunity to sell into this. But I think when you look at the way, for example, 4-hour charts, 8-hour charts, and the major indexes look, the sell-off appears to have resumed. I'm not at this point thinking the time to sell isn't now. I'm thinking, can I get a better level to sell from? But it looks like we're going to come back to retest lows from earlier in the month, the way things are setting up here. I only have exposure in the Russell at this point because it made the breakdown a little bit earlier, but it obviously didn't have as much follow through today. So I'm looking to be a seller of the S&P. I'm looking to be a seller of NASDAQ. Maybe I'll get a better crack at it tomorrow.
When you say looking
Fingers
to
crossed.
be, Ilya, are you suggesting that you think that there's room for some sort of a dead cat bounce? You're hopeful. Yeah.
I'm hopeful that when liquidity comes back after this big absence, this big gap on Monday, Europe was absent, Australia was absent, Hong Kong was absent. So tons of liquidity was off the board. I'm hoping when it comes back in, some degree of opportunism gives us a little bit of a lift after that kind of a sell-off, and I get something to sell into.
I mean, everywhere was red today for what it's worth. I mean, no matter, I think Indian stock markets and Chinese stock markets were slightly higher over the course of the session, like FXI is
Hong Kong was closed, so and FXI is Hong Kong. So ASHR, if you have a look,
0.67%.
Yeah,
right. It's substantial, but everywhere else you
not
look,
the worst.
Things are closed. So,
yeah,
what do you make of it? Either way, I think the point that you get across is that it's just a really bad risk-off day. Yes. Markets are bleeding lower, and a lot of that acceleration, because markets are closed for the most part in Europe, you can see how overnight futures trading is just kind of like melting and grinding to the downside. As soon as U.S. cash equities open up, that's when the selling really accelerates and begins. And it's because the news flow over the weekend was just kind of down and dour. President Trump's out talking about Fed Chair Powell. I mean, I do think the silver lining to all this is that if he really just wanted to fire Powell, then Powell had already been fired. We've gone through 5 IRS commissioners since he was inaugurated, right? So clearly it's not about getting rid of him.
I don't even say this with the political, obviously I have an opinion, but I just wonder the degree to which when the President of the United States issues an Easter message like this president did, like it just creates a sense of a lack of coherent leadership for the United States. Even if you love President Donald Trump, do you want your president offering Easter messages like that? It just doesn't make any sense. It just seems to me that it's just an indication of the fact that America has the marginal decision relative to America, whether it's as a tourist or a business person or as a currency trader, is to move away because it's an odd situation.
Yeah,
whether it's canceling your vacation, selling your dollars, or redirecting your business development, all of the marginal decisions are away from the United States.
Yeah, so the generous interpretation is that everybody has looked at the U.S. and said, okay, wait and see mode.
Mm-hmm. Yeah.
And that's sort of the most generous,
that's the kindest and most benevolent perspective.
Yeah. You could say, okay, well, they're just waiting for this thing to work out or not work out, but they're not giving it the benefit of doubt. And that's sort of the nicest you could say it.
Isn't the most alarming thing about the market now that Bitcoin is moving up with gold to such a degree? While the dollar's selling off, Ilya? It feels like it was remarkably stable, and it's now
not what you want to
serving, kind of serving as a capital flight vehicle.
Well, the dollar is getting crushed, so anything denominated in dollars is going to have a level of support. That Bitcoin is sort of popping to the top of its recent relatively lowish range is absolutely eye-catching. I wouldn't say it's something that suggests that sort of the architecture of the TradFi financial system is cracking, but the forces being unleashed here could actually see something like that become a credible story.
Dylan, am I losing my mind watching gold and Bitcoin perform the way that they are in a market that's seeing the NASDAQ bleed 2.5%? One of the worst days that we've seen across the board since September 22. Isn't Bitcoin supposed to be a risk asset? Why on earth Is it holding
No,
up?
I mean, I think you're asking an interesting question, which is, is this a moment where Bitcoin grows up into being well, first of all, what was the original Bitcoin conception was a non-state currency, right? It was out of the financial crisis, a different way to denominate flow of payments that is not state controlled, all the things that we blah, blah, blah.
Mm-hmm.
We're now at a moment where the US dollar is into a weakening trend, maybe a secular permanent trend to a less relevant currency. Maybe it's just a bad month, but there's enough news flow to support speculation that it's more than a bad month, although it might end up just being a bad month. But there's enough news flow to make it to drive that speculation. If the dollar is less powerful, which is the basic argument, then what is the alternative? And we've been through this 1,000 times, and it's not going to be the euro for the reasons because of no fiscal union, blah, blah. Anyway, is Bitcoin the alternative? No, but it is behaving like a risk-off asset at the moment, which is peculiar for its history. I mean, the other thing is because Donald Trump is privately so invested in the establishment of his own crypto world, it may be in Donald Trump's personal interests for the U.S. dollar to become less valuable, such that he hopes that the Trump coin can become the new global reserve currency. I'm not saying that that's what's going to happen. I'm saying that's the sort of thing that comes out of this man's mouth that he's capable of thinking.
I can't help but wonder that if we get some sort of, I tweeted this out years ago, that Trump was the first MMT president, and I didn't get many likes on that tweet. I thought it was a pretty sharp insight for how he's behaving into the COVID years. And so I think I'll say it again. Trump is an MMT president. In his world, we'd have blown out fiscal deficits and interest rates pinned at zero and the yield curve fixed by a FOMC that he controls. Isn't that around the corner here, Ilya? Like, if we game out, let's just say Trump gets Powell's gone next month, a year from now. He's going to get Kevin Warsh in there. He gets one of his guys in there, Kevin Hassett, Scott Bessent, who knows, Don Jr. He's going to get someone that's going to implement the policy that he wants, or try to.
Mm-hmm.
Isn't that Federal Reserve going to have to be angling towards yield curve control to provide the monetary policy offset that fiscal needs to detox the economy?
That's if you get a compliant Federal Reserve, but you don't have that kind of architecture. And
Why not?
Because the litigious nature of the United States is sometimes a burden and sometimes one of the greatest assets that the system has. Because it prevents rapid shifts to chaos to some extent and prevents singular actors from riding roughshod over everything the way, let's say, Recep Tayyip Erdogan might in Turkey, where those same guardrails don't exist, and that bureaucratic morass doesn't exist to the same extent. The bureaucratic morass is, in this case, a moderating force, as it were. The president has already floated the idea of firing the Fed chair. Powell has very clearly said, I will not resign if asked, and I will fight being fired because it is against the law to do it. Which means this is all going to get locked up in courts for extended periods of time. In the meantime, as you and I were talking earlier today, Chris, let's say he fires Powell from the chairmanship. He needs to nominate a new chair from within the existing set of Fed governors. He can't add anybody to the board. So, and the Fed operates by consensus anyway. So, okay, let's say you try to make Powell not the chairman. It's the same board. Powell is still on it. He just doesn't have the name tag in front of him. The upshot is the same. The relief here seems relatively clear. In fact, we know that the president can have bitter enemies that become dear friends and then bitter enemies and their dear friends at the speed of tariff policy reversals or faster. And if Powell were only to see rates cut, which is something that he's trying to do already, even before this administration took office, the thing might be diffused yet. But I think the sort of the big picture here is, if you think the US dollar doesn't have an alternative, this is the situation where it still doesn't, ultimately. But the level of incremental pain and how much cheaper it can get before those kind of end of system breaks kick in, there's still so much room. The world still owns so many dollars. There are still so many dollars you could sell that the pain probably continues. Maybe not in a straight line, but let's say the president comes out and says, you know what, I'm going to let Powell serve out the rest of his term. I'm not going to fight that part of the process. The markets would unclench, the dollar would unclench. But the trajectory is ultimately toward a weaker dollar. I don't think it's toward a systemic unraveling, because frankly, nobody is invested in that kind of an outcome because there's nowhere else to go.
I don't know. Maybe they're all short the dollar. maybe people are invested.
Yeah, but people do have to trade amongst themselves somehow. A non-dollar payments architecture that's comparable just doesn't exist.
No, that is true. And even if you talk about stressing out like the Eurodollar system, which is a break, like, the offshore liquidity in the market, if that breaks, do you think people are going to hold the dollar side of the equation or the euro side of the equation longer term? It would be a massive script, right? And that would probably be actually one of the signs that things are getting worse in this here, right? Like all of a sudden bonds are down, stocks are down, gold's down, and then the dollar starts to surge. It's like, oh, this is a liquidity crisis.
This is getting Armageddon-ish.
Well, for now, gold continues to serve that role. Like if you have to allocate your incremental unit of currency somewhere in the system and you're not going to put it into the greenback right now, do you really feel comfortable holding it in fiat altogether if the system itself is going to be pressured? Probably not. Right. For today, that theory still holds. Dylan, 3425.30 in gold here. I have potential targets up near 3,500 right now in this particular technical run. Is this the biggest alarm bell in the world right now for traders, that gold is just up 30% year to date? Because
I've been talking, as you know, I've been doing these morning discussions with Rich McDonald in London, and we sort of talked ourselves into short gold, long dollar last week, which was a catastrophic set of decision making on our part. But I mean, it's hard to see how this isn't a price extreme. I mean, listen, the trade hasn't worked. Thank God I made it small. All those things, Or I mean, either this is a secular shift in the value of everything because of a new American economic regime, which it has the appearance that it could be that.
Yeah.
Thus, the prices being what they're doing with it, whether it's the term premium in the bond market. You've just listed all these prices. We know what's going on: gold, dollar, blah, blah. Or Trump is predictably unpredictable on the one hand, and on the other hand, predictable in that sense that he always backtracks when it comes to the last moment, he backtracks. But even if he's going to backtrack this, you can't backtrack the fact that uncertainty and wait and see has become the de facto standard for all engagement with American economics right now. So even if Trump's going to backtrack, the fact that this could even be introduced as a new way of thinking, anyway, it's a circular way of saying either it's a new paradigm for the value of everything. The dollar's worth much less, gold is worth much more. A big ass recession is coming, or buy dollars and sell gold and wait for Trump to flip it around. And I honestly don't know which one is correct. I'm not even sure how to calculate the risk probability on both of them.
Well, I think, Chris, what you were saying before about whether there is, in fact, a Trump put in the bond market, that basically becomes the bogey. You're back to those levels where that's supposed to kick in. After today, the bond market is on the line. It's right there.
This is the low close post Liberation Day for ZB.
Yeah. This is the time. So we're what, at 4:30 Eastern almost? Some point in the evening today, there needs to be some kind of a tweet or something to unclench this.
I saw a great tweet earlier that's going to vibe with that sentiment as well. You know you're stuck holding a bag when you look at the monthly chart for support.
That's right.
When the analysis is like, well, this thing needs a tweet. That's FUBAR.
Yeah. No, you should. That's right. That's right. But this is where we learn. Is there a put? Or is
I think that's the lesson this week, because the economic calendar itself, Dylan, is really, all things considered, fairly empty. Talking about a few days from the 24th, durable goods and existing home sales. Ilya, I know you're paying attention to the PMI readings over the coming few days. Those are going through tomorrow. Well, that's actually the 22nd. So 22nd is Australia. 23rd Wednesday, that's going to be the UK, Eurozone, US. How bad are these PMIs going to be?
The expectations. Can I make it a two-part question? Sure. How bad are they going to be? And also, at what part of any economic report is the relevant part right now, considering the inflection point in global economic policy?
The only stuff in any of this now that matters, in my mind, is what number does it take to get the Fed to be able to justify cutting maybe as soon as May. And if you can,
okay, all right, go ahead.
That's it. The president is aggravating a conflict with the Fed. The markets have been screaming, by the way, in agreement with the president, let's just be clear, that the Fed needs to cut. That the release valve to all of this is Fed rate cuts. And inflation expectations in the bond market have been cratering to tell the Fed what the market thinks of his worries that the tariffs will cause inflation. They agree with him, but they just don't think it'll matter because they'll cause inflation that will be so painful that demand will be destroyed in a recession to such an extent that the net impact will actually be disinflation because of economic weakness. And they're saying, look, you need to cut. So the question for the economic data is, do you get something that looks substantive? If you get a bad set of PMIs, you can reasonably conclude that the next set of hard data is going to be bad again. The numbers out of the Citigroup surprise studies that, Chris, you and I watch, they're deteriorating again. U.S. economic data getting increasingly worse relative to forecasts again after a little bit of a stalling out. So all the ingredients are there. If the PMIs are really bad, Fed officials, because they don't have to meet until May, they can start coming out and saying it could be the time. We may need to ease faster than we anticipated. But you need to see hard data. And the more the president tries to pin Powell into a corner, ironically, the more he's flirting with delaying rate cuts because the Fed doesn't want to look like it's being coerced. The Fed might well be more open to cutting in May were the president to have said nothing.
That is the most damning aspect of all this turn of behavior to me. Ilya, part one of my thought on this today was articulated during Futures Power Hour, right? Like Powell is gone by May 2026, no matter what. Now, there's certainly a cadence to how that works. If he's inappropriately, illegally fired, and there's there's court cases and everything, maybe that just grinds out until, I think that would just grind out until May 26, right? So you just throw more and more uncertainty into a system here. But if the trade deals were really going well, why would you want Powell to start cutting rates right away? Right? You would, if the trade deals were here, if there was announcements about to be made, all of the president's time and attention would be focused on the trade deals and not demanding that there's a monetary policy offset from the fiscal drag that's occurring.
Right.
And it's an acknowledgement that there's no progress in the trade deals because the fiscal drag will continue to occur, and thus we need lower rates in Trump's eyes. So the Japanese delegation who's this weekend, Dylan, I'm sure you saw it. Maybe if you didn't, and maybe others did not themselves. They returned back to Japan, immediately went into the local news. The video is out there with subtitles. You could read it in Japanese and translate it in your browser. They're basically like, you have no idea what the American delegation wants. They don't know how to articulate their position. So Dylan, where's the off ramp here? I know this is now becoming a situation where
I think that it's a fool's errand for us to sit around looking for off ramps. I think the question is, either get out of the way of this entire thing, which has been basically my position as a trader, other than I'm holding my investment aspects. But from a trading standpoint, I've been out of the way. I foolishly moved in with my friend Rich McDonald last week on a short gold, long dollar, which worked as well as a fork in the eye. I think that the only question I would have is from a trade. You're the momentum guy. Does your sort of default momentum position? Why not buy gold, buy Bitcoin, like sell the dollar? Just let it that Trump's going to stick to his guns. That if I take you at your word, which I have no reason not to, you're just reporting the news that there's that the dynamic in the trade negotiations is disorganized and inconclusive, and that this is going to keep going on for a while. So you better get out of your dollars, get into your gold, blah blah. Make your list, and it's a risk-off market, and it's a euro, long yen, long Canadian dollar. The only thing you have going against you, the only thing going, all those things, just do it. The only thing you have going against you is, on any given moment, the president can be like, oh, now's a good time to buy.
Any given moment, all the positions that are doing well for me could turn on their head.
Every single one could be plastered by 10% the other way because of one whimsical comment, which is no way to live, sir.
Are you sure?
I'm not sure.
Are you sure? Are you sure? The momentum's really ugly. We never really could get back to that 1 month moving average, the yellow squiggly line on our chart here. When we bounced back into it, never quite got through 19,250. Same thing for the S&P 500. Hard to believe that was 320 points ago last week, Ilya, when we were talking about needing to get through 5,500 to really feel good about things. Now we're heading back down to the bottom side of the range. It could still just be a triangle that's coming together here off the lows, which just means a lot more chop. And I think that's probably the prudent path forward because, Dylan, as you point out, it's no way to live having to hang on to these tweets. But if there's ever a time for it right now, we see a Trump administration that has shown some sensitivity around a 10-year yield that gets to about 4.5% or a 30-year yield that gets to about 5%. And we're sitting on the precipice of that once more right now. So you see another spook in Asian hours tonight. It's very possible that we wake up tomorrow and it's a different world again because they announce some sort of, reframing so that Trump can save face and declare some sort of victory. Because obviously this effort to keep yields pending lower is not working. Dylan, you weren't on last call, but I'll say it one more time for the folks that weren't there either. One of the more astounding features of this market, talking about how people just aren't buying America. America's still on sale. Bloomberg today, their ETF flows guy, Eric Balchunas, reported, you look at flows incrementally, for example, coming out of Europe in 2024, 50 cents of every dollar that was invested into global markets coming out of Europe, 50 cents of that went into the US. In 2025 thus far,
What
only
is it?
3 cents
I believe
of every
it.
dollar.
I believe it. I believe it. I mean, I would have guessed much more than that. I'm shocked that it's that absolute of a maneuver, but I'm not surprised. I'm not actually surprised. I would have thought it would have gone from 50 cents to 25 cents. It went to 3 cents, huh? There's just no reason.
Really extreme.
You're sitting in your Milan, where I am, or you're sitting in Paris, or you're sitting in Frankfurt, or Munich, or London, or Barcelona, or Berlin, or Vienna, and there's 450 million people in Europe. There's more Europeans than there are. It's just that Europe's just disorganized and fractious in language. I mean, there's lots of structural challenges that make it inefficient, much more inefficient than America, but it's still more human beings, and it's still massive piles of money. It just has more concentration of wealth than even the United States, because it has these legacy families that own everything. They've been given every reason not to put money in America. Basically, America. They sent J.D. Vance whatever a couple of months ago and told America or told Europe to screw off, basically. And then they followed through with all these actions. The only question is, can America be made to work for, let's assume that basically anybody with money is an enemy of Donald Trump, whether it's an American with money or a foreigner with money, and Donald Trump works for the impoverished and lower middle class Americans who were left behind in the NAFTA transition in the 70s, 80s, and 90s. And that the idea is to basically reduce global wealth and redistribute wealth to his voters at the expense of everybody else. I believe that's his plan. I think the outcome is going to be less money for everybody, including his voters. But
yeah, it's going to be a shrinking pie, to be clear. It's not like the market is measuring all future income, all future cash flows. And it's saying that the value of the pie is worth much less moving forward. And that's not to say that the pie, and I retweeted this over the weekend from Mark Dow, the pie grew over the last 30 and 40 years, right? You look at per capita GDP, you look at, you chained it in like $1990, the percentage of Americans that are making more than $100,000 a year in $1990. So backtracking it for inflation, more people than ever. Right, so we are a wealthier society on a per capita basis over the past several decades. There's two problems with that, of course. One is that the luxuries in life seemingly are cheaper and more accessible than ever. You want to get a new phone, you want to get a nice car, fine. But the necessities have just absolutely skyrocketed too. So like you want to get a new house, you want to go afford college. You're not going to hear the stories.
You looking for a fried egg?
You're looking for a single fried egg.
You're looking for a fried egg, yeah.
Right,
but cost you, buddy.
Like back, you see the ratios. If I were to work at the minimum wage, how many hours would I have to work per month in order to pay the average level of rent in my area? That's been blown out over the past 30 or 40 years. It's outrageous. So that's one of the problems. But it's the trickle down, right? There's a great piece of data. I'm going to show the visual later on once I pull it up after I get off my little soapbox here. But what's happened since the first Trump tax cuts, the number of people who are worth more than $10 billion in America has increased by tenfold since the Trump tax cuts, right? And that wasn't the pace of wealth growth over time. And Dylan, you actually mentioned something that I do need a fact check here. Since 2018, the U.S.'s Gini coefficient has risen to exceed the broader European Union's average, the Gini coefficient being a measure of income inequality. So the pie's growing.
You're saying that
it's not being shared.
Inequality is worse or is more intense in the U.S. than it is in Europe.
At writ large now. It wasn't in the late 2010s. It has since flipped.
The transition to the United States being the most concentrated.
That the pie is
Well,
growing. It's
and-
just not being shared by enough people.
Which is
it's going to one place.
which is the source of Trump's power, and for that matter, Bernie Sanders' power. By the way, on the other side of the ledger, and it goes back to our, not to repeat the circularity of our discussion, but whether it's Bernie or Trump correctly identifying the problem, or people like us. No one's debating it. We got it. I got it. But the solutions. The solutions, in my opinion, sorry, Ilya, are never getting properly debated in a way that actually results in yielding some system of adjustments. Instead, it is either it's these extreme declarations from the far left of, tax the rich and whatever it is, which is obviously tax increases on certain economic classes have foundations for, I believe that they're a good idea personally. But the point is the way that all these policies, whether they're far left or certainly this situation, none of them are well vetted or have any apparent trajectory for success. And all of them are ultimately self-destructive. I mean, I really think we are living through the super large scale exhibition of Harvard's ultimatum game. We're in a behavioral economic experiment where people are doing what is against their personal self-interest because they would rather see everyone else suffer than to be left in such a disproportionate position relative to the wealth as it's created. And that's the basis of the ultimatum game, is I would rather have nothing and have you get nothing than to have you get a lot and me get a little.
And if ever there was a sort of microcosm way to see this exact thing in markets, it is, of course, that so much market cap has been baked into a handful of names on the NASDAQ. Because if you ever wanted to see why the Gini coefficient is showing what it's showing, we'll just consider who owns most of that most equity market value in recent years has gone to that one pocket. And if you consider that people's wealth is in part being measured by financial assets, which, yes, are subject to market risk, but not that much market risk until recently in practice, then you see how you get that disparity. Yes, it's paper wealth disparity to a large extent, but that doesn't change its political implications.
No, it doesn't. We have a day where, broadly speaking, the markets are down across the board. Even some Bitcoin-related stocks can't get a bid like Marathon Holdings. Dylan, the implications of Bitcoin performing well in this environment, if Powell is going to be fired, obviously the market hasn't priced that at 100%. We have to wait on some Supreme Court decisions. But it feels like we're, getting to a real breaking point here for a lot of different things.
No, I agree with you. I wonder where the Republican Party is right now. I mean, there's sort of two, the bond market and the Republican Party. Because those are the only two actual practical forces that exist right now that could tap the brakes on this whole thing. The bond market tapped the brakes that one time a couple weeks ago.
Yeah. There was an interesting quote, and
I haven't seen any Republican brake tapping. Sorry, go ahead.
I'll pull it up here. It's from Senator Kennedy of Louisiana, who's a very kind of hardcore right-wing Republican to the sort of farther side. And the exact quote, I want to make sure I read this verbatim because it's such a good quote. He said, "My experience with Jay Powell is that he's got tiger blood. He's going to do what he thinks is right, and he's not going to go down in history as the Federal Reserve Chair that allowed inflation to become wild as a March hare. He's going to do what he thinks he's got to do." Maybe this is some kind of a sign of something.
Well,
I
what
don't
are you
know.
suggesting? You're suggesting that the Republicans are going to try to hide behind Powell as a way to so that they don't attract so much inbound from the Trump administration.
I think they're going to try to defend Fed independence because I think even for them this is a bridge too far.
It's just.
And then basically hope the bond market and the Federal Reserve.
And if that were to happen, the
brakes.
bond. Well, consider how silly it was that the market found any kind of reprieve in this pause.
In retrospect, it's
in the reciprocal tariffs. I mean,
the 9% update.
Okay, in fairness,
we were saying
had that
this at the
update,
time.
and we said the math just doesn't check out, and like this is something difficult to really
Right?
like.
We said
like,
it on the day
second.
of.
Like
We
the
said it
announcement
the day
itself is
of, right?
exciting, and the second you look at the trade weighted data, it's like, hold on, this brings the effective tariff rate from 27 to 24. Okay, so this is still a tenfold.
Right, but it made me reflect on it. I'm sorry, I'm talking over you guys, but like, did the bond market even tap the brakes?
It sort of paused
Go to TLT.
the bleeding, kinda.
Did it? I mean, it delayed.
Kinda.
I mean,
But only kinda.
yeah.
But only kinda.
I mean,
And so
it bought a week.
it bought a week. And of course it only bought a week. We said this at the time. What has the president done? He's injected more uncertainty into the tariff rollout. What has been the problem with the tariff rollout? The uncertainty.
He won the Mar-a-Lago Golf Championship.
He did.
Who did?
He did.
Trump.
Oh, doesn't he win every year?
He has.
Well, it's
yeah.
the Mar-a-Lago Championship.
Every day?
That's how this works. Yeah, I mean, it's. We said this at the time. We said, "Oh wow, look at this stocks rally. This is not going to hold."
I mean,
we
but
are.
here's the other side of the. I'm just thinking out loud, but this whole time the market is fundamentally, obviously adjusted. Lower equity prices, higher gold, bond, dollar. We've talked this ad nauseum. However, the magnitude of the price changes has not been nearly as big as it would be were all of these tariffs to actually be implemented. There's always been a constant discounting of the fact that whatever happens, something's going to happen. Uncertainty is the rule of the day. Wait and see is the attitude of the day. But whatever happens, it's not going to be nearly as bad as what's being talked about right now because Trump always makes there's always some sort of a something.
Right.
And that's why the bond market isn't really tapping the brakes. The bond market is saying, you know what, there's no way it's going to be that bad.
I mean, you have to figure that as bonds are falling back, there are people who are looking at it and saying, yeah, but I can get 4.5% on the 10-year, lock it in right now. I'm happy to hold that. I can hold that. I don't think the U.S. is going to default on its debt in the next 10 years, right? Well,
yeah, maybe, but it's being taken out in the currency. That's my issue with the whole bond thing is the bond market may not be doing much work, but the currency market sure as hell is.
Well,
yes.
That's the whole thing. Yeah.
And this is an interesting chart from Robin Brooks, who's done a number of things on the government, non-governmental level in the world of macro. He talks a lot about currency. So if you're interested in like the mechanics of the currency market and capital flow, him and Brad Setzer are the two folks you got to follow on Twitter. He here had a tweet earlier that's outlining the paths of the 2018 versus 2025 tariff impact. You can see how stocks, the blue line in 2025, are already underperforming the way stocks behaved at the onset of the 2018 trade war. Although somewhat fascinating, you could see from the start of January 2018 until about April, that's when the pain really comes in. And we're kind of at the same calendar point where Trump started to change his messaging back then a little bit. You see here with the dollar is getting crushed. G10 or G10FX are soaring versus the greenback right now. But again, when did we see the turn in Trump's tone? It's April, May of 2018. So the 4.5% on the 10s, 5% on the 30s. Crazy news stories from the Japanese trade delegation Americans don't even know what they want. Okay, so we're all being pretty doom and gloom here about the state of things, and obviously this can change in a second. And as traders, right, I want to remind everyone, as traders, you have to reserve the right to change your mind. If tonight Trump tweets that he's backing off and they're opening up, they're going to do everything through the WTO, as corrupt of an institution it may be, because they've helped China launder cheap goods to the rest of the world, yada yada. The market unclenches. There's at least a temporary multi-year downgrade to U.S. credibility, trustworthiness as a counterparty. It's not going to resume capital flows directly into the U.S., but trade isn't going to fall apart, so you're going to see a nice relief rally. It's a nice story to tell ourselves.
Yeah.
I think the key here is like approaching this mechanically as a trader. You just got to make sure you're staying small. I much prefer right now to operate in futures that are liquid as opposed to the ETF equivalents, because Trump tends to tweet later in the day. There are a myriad studies on the distribution of when Donald Trump or the White House releases remarks. It seems to be clustered after 1 p.m. and then a lot in the evening. So if you're going to be trading in these markets, having access to a vehicle that allows you to move in and out, I think is prudent. It doesn't need to be ES, it could be MES. It doesn't need to be the futures themselves, it could be the options on the futures. Although if you're trading overnight, MES is much more liquid than trying to get in out of a call spread where liquidity could be thinner, depending upon the expiration you're looking at. But if you're going to be trading these markets, you need to have a plan and have alerts set so that when things happen, you know how to respond. I suppose in terms of positioning for tomorrow, I'm going to keep on the long yen. I'm going to keep on long gold. Unfortunately, getting kicked in the teeth with this ongoing attempt at a short put spread exposure, just hoping for theta burn in ES, which is not working out well. The short iron condor trade in ZN is fine because the thing continues to chop around. The short put spread in ZB is suffering, but it's not dead yet. Some of my utility stuff came back in a little bit today, although, again, long the 42, short the 47 call spread here, so there's plenty of time on the board. I don't see a reason to change anything, but I find the gold Bitcoin outperformance over the NASDAQ today, when bonds and dollar melting down, to be one of the clearer signs that we're heading into a world that just is, we need an off-ramp where things are about to get potentially a lot more difficult in a real way.
One thing I suppose you can hang your hat on is the president's job approval ratings from an average of polls that I look at from Real Clear Politics is crumbling. And we know the president doesn't like that. We know he's attentive to these types of things. Now, of course, he doesn't have to run for re-election unless he does want to entertain some of the kookier ideas that have surfaced out there about finding a extra constitutional way of doing that. I know Steve Bannon has been out there saying that a lot to any media outlet that would listen. But presuming that norm holds, the president ought not care necessarily about this, but he certainly does seem to care generally and constitutionally about sort of his party being able to ride his coattails and him being able to say, I delivered, you're all getting all this political support because of me. And so maybe with the bond market at its pain point, popularity falling, and internal Republican grumbling mounting, maybe there is, in fact, a release valve here. But what a trading strategy it is to consider looking at risk allocation around those kinds of catalysts.
Dylan, give us something positive to talk about here. Today was obviously a very big news day. Of course, Pope Francis died. I find it incredibly interesting that as America goes through its own Brexit moment from global trade, similar to how right after Liz Truss met the Queen and the Queen died, right after J.D. Vance meets the Pope dies. What's the view from Italy? How big of an event is this? Is this something that's going to impact the European economy in any way whatsoever? Italy's
No,
role, burgeoning role?
I mean, those are two very. I'm going to separate the passing of the Pope from everything else because I think that. So let me set that up. I'll save the. We have 5 minutes, so I'll give you a minute on that at the very end here. The optimistic statement I'll make is this: Donald Trump always backtracks, always retracts, always changes path. There's a reason that the bond market. I know things are looking grim. But things looking grim is part of the routine. It's like producing a reality television show, except for the reality television show is global economic expectations. And so I would say that the most optimistic thing I could say is, you're not dealing with a Powell or even a John Roberts or somebody with a history of sort of very mature, very resolute, very unwavering character who deeply considers decision making, and then once the decision is made, follows through with that decision. You're dealing with someone who's intensely impulsive, fickle, and changes their point of view on a daily basis. And there's a reason that the bond market is not tapping the brakes yet in the way that it could or it might on a Liz Truss, for instance. And it's because there is still an underlying expectation that whatever happens with Trump, it'll cause a slowdown, it's causing uncertainty, it's causing wait and see, but it's not going to cause the full cratering that that full implementation of what's being discussed would imply. So I'd say that the most optimistic thing I could say is the wild policies that you're seeing are being prosecuted by someone who has zero credibility when it comes to follow through on things like this. Regarding the passing of the Pope, there is no economic consequence of the passing of the Pope. There is a spiritual consequence, there is a cultural consequence, there is a religious consequence, there's a consequence in Italy. This was a revolutionary individual, this Pope, in terms of the doors that he opened and the manner in which he opened the church to people in a way that no previous Pope ever had. That personally, I think, was a really beautiful thing. And there are two prevailing lines of thought in Rome right now, from discussions with people that are in direct contact with the cardinals and it's a whole world, right? The conclave and the smoke and all this. There's one school of thought which is that this Pope has opened up a path towards liberalization in the Catholic Church that shall never be closed. That it cannot be closed. That generationally and culturally, that this is the future of the Catholic Church. There's another school of thought, which is that it's like that the papacy is much like global politics, where when you have a liberal leader, then you're going to get a conservative leader, and you're going to get this sort of backlash with a more conservative leadership in the Catholic Church. Personally, I believe that both are likely. I think there will be a more conservative leadership that is brought in as the new Pope, as will be my guess, and that it won't matter. I think that it will continue to be on the path of Pope Francis, even if there is not a Pope Francis II who is brought in. It is not economically relevant, but I believe it is morally relevant, especially because this Pope was such a great advocate for the global South, which is all of South America, all of Africa, by far the most abused aspects, or the most abused communities, nations, by the global economic system. And I'm hopeful that there is an advocate for those communities that finds his way to the Vatican once again very soon.
With that, Overtime is out of time for this Monday, April 21st, 2025. We'll be back tomorrow, same time, same place, 4 p.m. Eastern, 3 Central, right after last call. So for Dylan Radigan in Milan, Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. We'll see everyone again soon. After a brief break, more Tasty Live coming at you. Ilya Spivak up next with Macro Money.
See you there, everybody. Well, the bloodletting has resumed. Took a little bit of a break last week on a shortened Easter holiday run in the markets. But as we begin this week back from that holiday, the risk-off train is steaming forth. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we're going to take a look at what might be animating these markets in the week ahead as the pain has seemingly returned. We see the markets once again under heavy pressure on a thin holiday held back Easter Monday, because of course in the US markets were open, but in Europe we have closures pretty much all around the major exchanges. Hong Kong is closed, Australia, New Zealand. So very, very thin liquidity and not a lot of conviction perhaps behind today's moves, but nevertheless a brutal tone to all of it, and for understandable reasons. We'll unpick those here momentarily, but first, let's get an anchor here in the price action that played out last week. We can see stocks back under pressure. S&P 500 down 1.5%, NASDAQ down 2.3%. That's after those blistering gains in the prior week, and in fact, those jumps there, 5.5% for the S&P, 7.2 for the NASDAQ. Those were modest versions of just how strong the prior week's rally really looked, and we'll take a look at it in just a second. But back to selling last week following those gains, and although looking just at the percentage changes here, it looks like, oh, well, we had massive rallies and then a bit of a correction, nothing to worry about. Well, it doesn't quite stack up that way when we look at the price action. Similarly, for the bond market, we had massive, massive surges in yields last 2 weeks, and the very last week, a little bit of a pullback on that. Bond markets cratering and then somewhat steadying last week after that aggressive move. And the sort of consistency in all of this still being found in gold, which posts yet another week on the upside, 2.6% after a 6.9% gain, and the dollar keeps selling off, perhaps in a parallel fashion, down another 0.5% against the euro, 0.9% against the yen. Bitcoin starting to benefit from the relentlessness of dollar selling, up 1.2%, despite the defensive tone and overall risk sentiment, as is very clearly epitomized here by the stock market. And so we have something like a pause of sorts last week, at least for the core markets. The dollar keeps limping down, gold keeps clawing its way higher, but crude oil is up as a kind of measure of cyclicality and recession risk. Yields unclench a bit, and although stocks come down, they come down after what are massive rallies, and so perhaps things aren't quite so bad. Well, not so fast, because the pain has resumed in earnest this week. Here's the S&P 500 right here, and we can see just what that massive rally was. It was a single day off 15-month lows here. Just one day where we had an announcement, 11th hour announcement to boot from the Trump administration, the president putting out a post via his Truth social media platform, saying that the reciprocal tariffs that he'd announced on so-called Liberation Day, when he unveiled bilateral tariff rates across most major U.S. trading partners, and in fact, almost all countries that the U.S. does business with, from Belgium to Botswana, as it were, and said that the new baseline tariff of 10% would hold, but everything above that would get put on pause for 90 days, except for China, which would not get a pause, and that this pause would give some space for perhaps the start of negotiations and some kind of a reprieve. And while the average U.S. tariff before the new minimum 10 was closer to 2, we still have a 5-fold increase in U.S. tariffs any which way you look at it. The markets looked at the episode and said, okay, we have a bit of a reprieve, a bit of a response to market discipline, because, of course, going into that announcement, that sort of softening of the on-ramp, the markets were in near free fall. So, okay, this is a little bit better. We can perhaps unclench a bit. And that lasted for all of one day. It was an explosive one day, but only one day. And of course, now we have almost fully erased that move as we get back on the defensive today. Now, the reason it lasted only one day seems pretty straightforward, and we discussed it when it occurred, essentially the day of, and put forward the idea that if the sell-off initially from about mid-February, late February, is a reflection not of the idea that there are tariffs, because that much was known back in November, and clearly no vicious sell-off materialized then. If that's not the reason, then what is? Well, it's the turn in U.S. economic data and the signs that the implementation of the tariffs is creating a situation where now you have a sense that business confidence and consumer confidence have been negatively impacted by how things are occurring, that this has put the brakes on economic activity, and that what is then following is a hit to growth, not so much because there is a tariff regime, but because of what the tariff regime is and how it is being put in place. That consumers and businesses are withholding money that they would have otherwise spent or invested around uncertainty, and that what this is doing is it's hitting the economy and creating a growth scare. And this is what the concern is. Well, if it's uncertainty that's the issue, then rolling out a schedule of tariffs and then days later pausing some of them for 90 days creates yet another cliffhanger and creates more uncertainty, which of course doesn't resolve the issue but compounds it. And so after this one-day relief jump, the markets hit a wall, tellingly at former support become resistance, and settle into an easy range until the latest offense hits the tape and the markets have the chance to show their displeasure with the president taking pot shots at Fed Chair Jerome Powell, saying his termination cannot come soon enough, bemoaning after last week's ECB rate cut that the Fed is not following suit and isn't cutting interest rates. That, of course, has spooked the markets because one of the bastions of U.S. economic credibility is the independence of Federal Reserve monetary policy making. And if the president is dictating what interest rates ought to be and what the central bank ought to do, and threatening an extrajudicial firing of the central bank head, who himself has asserted time and again that such a firing would be illegal and would be fought in court, that more uncertainty has entered into the picture. Whatever you might think of the president's opinion on interest rates, the Fed's resistance, the rules that govern the Fed's independence, whatever might be one's opinion of those things being right, wrong, or what have you, they have been a system that has served and served well, and the markets now see a threat to that architecture, and that, of course, makes for more uncertainty. And that uncertainty, not surprisingly, has once again taken stocks lower. We have essentially started the return back in the direction of the lows from the beginning of the month. The pain is even more acute in the bond market, and this is now a weekly chart just to show a little bit more the overall state of things and just how critical of an inflection point we're at. Bonds stabilized a tad last week. That's after that massive sell-off that we mentioned that gave that surge in yield that we showed earlier. This was that right here. And now with this attack on the Fed, bonds are right back to those lows. They're right back to where they closed on that brutal week where the situation looked so dire. And so the question now, of course, becomes, are we essentially back at the brink? Was last week just the short pause in the process, and now the intensity of the sell-off is ready to reconstitute and the panic to move forward? Now, this perhaps is nowhere captured better than the bond market, because what the market seemed to have concluded when the president rolled out this reprieve, such as it was, on reciprocal tariffs, was that the bond market had gotten to some kind of a pain point. That what the president wants, this is ostensibly why he is berating Jerome Powell, is lower interest rates to smooth the on-ramp of all of his new policies, which would be, not surprisingly, more digestible, were money cheaper. Now, what we have as a result of these efforts is money that's more expensive. When you have this massive decline in bonds, that the flip side of that, of course, is a surge in yields. Again, that same decline in bonds corresponded with a 12.4% jump in the 10-year rate, 9.1% jump in the 2-year rate. So why is it that the actions being taken here and the uncertainty that we see in the stock market, why aren't bonds going up with that? Are they not a safe haven? Is that not what you typically see? And of course, breaking this down into the constituent components is what it takes to see exactly what's occurring. Now, in the brown here, what you have is the term premium that's embedded in 10-year nominal yields. So when we say, oh, the 10-year yield, you can break that 10-year yield out into components. One component is term premium, which is compensation for uncertainty risk. That is the passage of time. If you think more can go wrong over the allotted time, let's say this is a 10-year rate, so if all of a sudden you think more can go wrong in that 10 years than you did before, well then you're going to demand as a lender to be compensated more for that time, for that additional risk. And we can see that risk is surging. At the same time, the break-even inflation component of the bond yield, that is inflation expectations reflected in the treasury market, that's falling. As if to say, yes, we do need rate cuts because all of this consternation and all of this uncertainty is going to bring on a recession that's going to be deep enough that whatever one-off hit that the tariffs engineer that pushes inflation higher is going to be offset because demand is going to be so hurt by these policies, and the recession so deep that the net result for inflation will actually be lower. That what you get in terms of inflationary pressure from basically increasing consumption taxes, sales taxes as it were, on imports in a drastic way, that will be offset for the aggregate inflation rate for the country, because demand for everything will drop out of the bottom. And so this is how you end up with bond yields surging. So the upshot is that the result of all of these things has been precisely, taking the president at his word, what he doesn't want, which is to say higher borrowing costs. Now, the markets have, of course, reasoned that if a deep recession is in fact coming, then the Fed will in fact have to cut more. And we have seen that develop here over the recent weeks. As we've had stocks come off, so too the markets have baked in more easing. But we can see that the resistance from Chair Powell recently really does show up here in Fed funds futures. There hasn't been a whole lot of movement on this. We're sitting at about 115 basis points being priced in for the year. The markets in that are not so far off the Fed's own forecasting. This was the March update of the Summary of Economic Projections, where the Fed said from a base of 4.4% center line on rates, we're coming down to 3.9% this year, 3.4% next year. This is 50 basis points in cuts. This is another 50 basis points. That is to say, 100 basis points or 1% in cuts through the end of 2026. The markets are only 15 basis points more than that, so about 50-50 on a fifth cut. That's not that far off considering all of the consternation. The markets think that the cuts need to be a little bit more urgent, so they see maybe closer to 3 erring on 4 this year, maybe another one next year. But sum total, we're not so far away, a little bit more dovish than the Fed, but not so far away as to explain what's going on in bonds. And the timeline for those cuts looks very much like the Fed is going to delay until mid-year. Looking now, a full 25 basis point rate cut doesn't really get discounted until July. And then from there, we start to see more sizable consecutive hits, and the outlook starts getting a lot more dovish. Now, this is where the release valve on this consternation may very well find itself this week. There's not a whole lot of macro data on the calendar, but we do know the Fed wants to cut, and we do know the market would perhaps welcome some dovish squawking from the Fed. It certainly seems to say that the Fed has clearance to cut in what it's showing in its assessment of inflation expectations. And if the Fed were to start to talk as though it might be likelier to cut sooner, well, then perhaps some of the pressure from the White House would ease and the situation might be unwound. How likely that's to happen hinges on a couple of things this week in terms of what the markets will look for. The first will be an update of economic projections from the International Monetary Fund. The annual meetings of the fund and the World Bank are happening in Washington, D.C. at the moment. So we can see here that this is the last update from January, and the expectation is very steady from 3.2% global growth in 2024 to 3.3% the subsequent years. The advanced economies going up from 1.7 to 1.9 this year, then cooling somewhat. Very modest. The U.S. outlook, it's toward slowdown, but not a significant one, down to 2.1% in 2026, which is still quite fast by U.S. standards. China seen continuing to slow from 4.8 to 4.6 to 4.5%, but again, nothing catastrophic. But of course, this is January. So the markets will be very interested to see to what extent this is now slashed, given what's occurred and how the outlook has changed, and just how much red ink appears on this when these numbers are updated tomorrow. Next will be the set of flash PMI numbers from S&P Global. This will be April data, and this was the beginnings of where the market started to worry about the rollout of these tariffs and other elements of the Trump administration's fiscal policy and the impact on growth. This is where the markets really got concerned. The PMI data in late February the 21st, if memory serves, is the first kind of batch that really gets things going. This is where those concerns arise. So watching how this develops going forward will be very interesting, because, of course, if you do see a very significant drop-off in the PMIs, wouldn't be a stretch to then look ahead and say, we are going to likely see this show up in the hard data that the Fed needs to see, but perhaps it will be enough to get the Fed at least talking about becoming more dovish. And then the hard data would validate, and they could get to cutting and get to walk away from this headbutting with the White House. The expectations seem to suggest that indeed a meaningful slowdown is probably on the cards. Manufacturing seems getting back into contraction mode for the U.S. As ever. These things are in a logic centered around 50, where that's neutral. Above it is growth. Below it is contraction. The faster you go, the further you go above 50, that is, the faster the growth. The further you go below 50, the faster the contraction. So this 49.4 here on manufacturing in the forecast, that speaks to contracting manufacturing in April being the baseline, and a significant slowdown in services from 54 to sub 53 expected. The numbers out of Europe don't look all that great either. The composite expected to slow there. For the UK, the same thing, back to standstill on growth there. In Japan, contraction. In Australia, contraction. So the story looks to be that of negativity. And of course, that shouldn't be much of a surprise, looking at the Atlanta Fed GDP Now model just as a barometer of where the data is going. Never mind the actual levels, whether the economy shrinks something like 1% or maybe just doesn't grow, or whether it shrinks between 2 to 3%, depending on the model here. That's less relevant than the trajectory of where things are going. And clearly they are going down. And that's the key takeaway. The data that's incoming daily to populate this model is very clearly pointing lower. In fact, Citigroup's Economic Surprise Index for the world is telling us that the generalized story here from March into April for global economic news flow is to increasingly start to deteriorate relative to forecasts. So if we get very negative results, and perhaps the Fed then starts to sound more dovish, then maybe we get a little bit of an off-ramp here, and stocks can steady and bonds can steady a bit, and perhaps even the dollar can start to come off its lows. But it is a delicate dance, and we would be hoping that the data is bad enough that the Fed relents, which is hardly something encouraging for the economy or for risk sentiment longer term. The last bit the markets can perhaps surmise is maybe there will be another policy reversal via midnight Truth Social update, and that might happen, of course, because the president seems to be increasingly unpopular. The polling here from Real Clear Politics, an average, telling us that the gap between approve and disapprove is widening increasingly to disapproval territory by about 3.6 points, it looks like, on average. And perhaps that is a forcing function for yet another reprieve of sorts. But without that, the architecture here seems to be, if only we could just get the Fed to cut with enough evidence of a deep enough recession, then maybe sentiment can unclench, but for how long? If the reciprocal tariffs example holds, then maybe we get a violent rally, but whether it holds or not is another story altogether. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am back with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.
Oh, yeah, it is Monday, April 21st, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth.